Morning. Morning. I'm Warren Buffett, chairman of Berkshire, and this is my partner, this hyperactive fellow over here is Charlie Munger. And we'll do this as we've done in the past, following the Saddam Hussein School of Management. We're going to go through the business meeting in a hurry, and then we're going to do questions, and we'll do those until 3:30 with a break at noon, when we'll take off for 30 minutes or so while you can grab lunch. And those of you, we're operating in an overflow room as well, so those of you who are in the overflow room now can join the main floor after the noon break, because we'll have plenty of room then. We'll go until 3:30. We'll try to get to all the questions we can. We've got 11 zones, 10 of them in this room, and we'll just make our way around them. I've got a little map here which I'll get oriented on here in a second. And let's see. And I think we'll get through the business meeting now. And incidentally, I don't see that movie before it's shown, but that was one of our directors singing at that final session there. We keep costs down at Berkshire. Okay, the meeting will now come to order. I'm Warren Buffett, chairman of the board of directors of the company, and I welcome you to this 1998 annual meeting of shareholders. I will first introduce the Berkshire Hathaway directors that are present in addition to myself. So we have, and I can't see very well with the lights here, but if you'll stand as I name you: Susan T. Buffett, the vocalist; Howard G. Buffett, the non-vocalist; Malcolm G. Chase; Charlie, you've met; and Ron Olson; and Walter Scott Jr. Also with us today are partners in the firm of Deloitte & Touche, our auditors. They are available to respond to appropriate questions you might have concerning their firm's audit of the accounts of Berkshire. Mr. Forrest Crutter is secretary of Berkshire. He will make a written record of the proceedings. Ms. Becky Amick has been appointed inspector of elections at this meeting. She will certify to the count of votes cast in the election for directors. The named proxy holders for this meeting are Walter Scott Jr. and Mark D. Hamburg. Proxy cards have been returned through last Friday, representing 1,039,276 Class A Berkshire shares and 1,080,509 Class 276 Class A Berkshire shares and 1,080,509 Class shares. The number of shares represents a quorum in the meeting. We will conduct the business of the meeting and then adjourn the formal meeting. After that, we will entertain questions that you might have. First order of business will be a reading of the minutes of the last meeting of shareholders. I recognize Mr. Walter Scott Jr., who will place a motion before the meeting.
I move the minutes of the reading the minutes of the last stockholders meeting be dispensed with.
Do I hear a second? A lot of seconds. The motion has been moved and seconded. Are there any comments or questions? We will vote on this motion by voice vote. All those in favor say aye. Opposed? Motion's carried. Does the secretary have a report of the number of Berkshire shares outstanding entitled to vote and represented at the meeting?
Yes, I do. As indicated in the proxy statement that accompanied the notice of this meeting that was sent by first-class mail to all shareholders of record on March 6, 1998, the record date for this meeting, there were 1,199,680 shares of Class A Berkshire Hathaway common stock outstanding, with each share entitled to one vote on motions considered at this meeting, and 1,245,081 shares of Class B Berkshire Hathaway common stock outstanding, with each share entitled to 1/200th of one vote on motions considered at the meeting. Of that number, 1,039,276 Class A shares and 1,000,509 Class B shares are represented at this meeting by proxies returned through last Friday.
Thank you, Forrest. For shareholders present who wishes to withdraw a proxy previously sent in and vote in person on the election of directors, he or she may do so. Also, if any shareholder vote in person on the election of directors, he or she may do so. Also, if any shareholder that is present has not turned in a proxy, please identify yourself to meeting officials in the aisles who will furnish a ballot to you. Those persons desiring ballots, please identify themselves so that we may distribute them. The one item of business of this meeting is to elect directors. I now recognize Mr. Walter Scott, Jr. to place a motion before the meeting with respect to election of directors.
I move that Warren E. Buffett, Susan T. Buffett, Howard G. Buffett, Malcolm G. Chase, Charles T. Munger, Ronald L. Olson, and Walter Scott, Jr. be elected as directors.
Is there a second? It's been moved and seconded that Warren E. Buffett, Susan T. Buffett, Howard G. Buffett, Malcolm G. Chase, Charles T. Munger, Ronald L. Olson, and Walter Scott, Jr. be elected as directors. Are there any other nominations? Is there any discussion? Nominations are ready to be acted upon. If there are any shareholders voting in person, they should now mark their ballots on the election of directors and allow the ballots to be delivered to the Inspector of Elections. Would the proxy holders please also submit to the Inspector of Elections a ballot on the election of directors, voting the proxies in accordance with the instructions they have received. Ms. Amick, when you are ready, you may give your report.
My report is ready. The ballots of the proxy holder in response to proxies that were received through last Friday cast not less than 1,039,298 votes for each nominee. That number far exceeds a majority of the number of the total votes related to all Class A and Class B shares outstanding. The certification required by Delaware law of the precise count of the votes, including the additional votes to be cast by the proxy holders in response to proxies delivered at this meeting, as well as those cast in person at this meeting, if any, will be given to the Secretary to be placed with the minutes of this meeting.
Thank you, Ms. Amick. Warren E. Buffett, Susan T. Buffett, Howard G. Buffett, Malcolm G. Chase, Charles T. Munger, Ronald L. Olson, and Walter Scott, Jr. have been elected as directors. After adjournment of the business meeting, I will respond to questions that you may have that relate to the businesses of Berkshire, but do not call for any action at this meeting. Does anyone have any further business to come before this meeting before we adjourn? If not, I recognize Mr. Walter Scott, Jr. to place a motion before the meeting.
I move that this meeting be adjourned.
Second? Motion to adjourn has been made and seconded. We will vote by voice. Is there any discussion? If not, all in favor say aye. Aye. All opposed say I'm leaving. This meeting is adjourned. Charlie and I may not get paid much, but we work fast on an hourly basis. Now we're going to do this by zones, and I think you can see who is manning each. Yeah, I see we've got a number out there already. And please ask just one question. The only thing that I can think of that we won't discuss is what we're buying or selling, or maybe buying or selling. But we'll be glad to talk about anything that's on your mind. So let's go right to zone 1 and start in.
Thanks for the beautiful, beautiful weekend in Omaha. I'm Micah Sale from New York City with a question for Warren and Charlie about what makes a company's price-earnings ratio move up relative to other companies in its industry. How can we, as investors, find companies and even industries that will grow their relative price-earnings ratios as well as their earnings? And thank you for the wonderful weekend and for sharing your brilliance with the shareholders.
Oh, thank you.
Thank you.
It's very simple that relative price-earnings ratios move up because people expect either the industry or the company's prospects to be better relative to all other securities than they have been than their preceding view, and that can turn out to be justified or otherwise. Absolute price-earnings ratios move up in respect to the earning power or the prospective earning power that is viewed by the investing public of future returns on equity, and also in response to changes in interest rates. And in the recent, well, really ever since 1982, but essentially in recent years, you've had decreasing interest rates pushing up stocks in aggregate, and you've had an increase in corporate profits. Return on equity of American businesses improved dramatically recently, and that also, and people are starting to believe it. So that has pushed up absolute price earnings ratios. And then within that universe of all stocks, when people get more enthusiastic about a specific business or a specific industry, they will push up the relative PE ratio for that stock or industry. Charlie, you've got anything?
Yes, I think he also asked, how do you forecast these improvements in price earnings ratios?
That's your part of the question.
Around here, I would say that if our predictions have been a little better than other people's, it's because we tried to make fewer of them.
We also try not to do anything difficult, which ties in with that. We really do feel that you get paid just as well. You know, this is not like Olympic diving. In Olympic diving, you know, they have a degree of difficulty factor, and if you can do some very difficult dive, the payoff is greater if you do it well than if you do some very simple dive. That's not true in investments. You get paid just as well for the most simple dive as long as you execute it all right. And there's no reason to try those 3.5s when you get as long as you execute it all right. And there's no reason to try those 3.5s when you get paid just. So we look for 1 foot bars to step over rather than 7 foot or 8 foot bars to try and set some Olympic record by jumping over. And it's very nice because you get paid just as well for the 1 foot bars. Okay, zone 2.
Good morning. My name is Joe Lacey. I'm from Austin, Texas. In this era when the financial departments of the institutions of higher learning are referring to you as an anomaly, and they preach the efficient markets hypothesis, stating that you can't outperform the market, where does one go to find a mentor like you found in Ben Graham, someone you can ask questions to regarding value investing?
My understanding is that the University of Florida has instituted a couple of courses that actually Mason Hawkins gave them a significant amount of money to finance, and I believe they're teaching something other than efficient markets there. There's a very good course at Columbia, I know, that it gets a lot of visiting teachers to come in. I go in there and teach occasionally, but a number of practitioners. I think the efficient market theory is less wholly writ now than it was 15 or 20 years ago in universities, but it's than it was 15 or 20 years ago in universities, but it's 20 years ago, and I'd recommend, you know, looking into those 2 schools. It's really quite useful. If you had a merchant shipping business, if all of your competitors believe the world is flat, you know, it is a huge edge, because they will not take any they will not take on any cargo to go to places that are beyond where they think they will fall off. And so we should be encouraging the teaching of efficient market theories in universities. And it amazes me, but what it amazes me, but what most economical about ideas that they make the ones they learn in graduate school last a lifetime. And what happens is that you spend years getting your PhD in finance, and you learn theories with a lot of mathematics in them that the average layman can't do, and you become sort of a high priest, and you get an enormous amount of yourself and ego and even professional security invested in those ideas, and it gets very hard to back off after a given point. And I think that to some extent has contaminated the teaching of investing in the universities. Charlie?
Well, I would argue that the contamination was massive. But it's waning.
Yeah, it is waning.
It's waning. The good ideas eventually triumph.
Yeah. The word anomaly I've always found interesting on that, because after a while, I mean, Columbus was an anomaly, but what it means is something that the academicians could not explain, and rather than re-examine their theories, they simply discarded any evidence of that sort as anomalous. And I think when you find information that contradicts previously cherished beliefs, that you've got a special obligation to look at it and look at it quickly. I think Charlie told me that one of the things Darwin did was that whenever he found anything that contradicted some previous belief, he knew that he had to write it down almost immediately, because he felt that the human mind was so conditioned to reject contradictory evidence that unless he got it down in black and white very quickly, his mind would simply push it out of existence. Charlie knows more about Darwin than I do. Maybe he can explain that.
Well, I don't know about Darwin, but I did find it amusing. One of these extreme efficient market theorists explained Warren for many, many years as an anomaly of luck. And he got to 6 sigmas, 6 standard deviations of luck. And then people started laughing at him because 6 sigmas of luck is a lot. So he changed his theory. Now, because 6 sigmas of luck is a lot. So he changed his theory. Now, see,
I'd rather have the 6 sigmas of luck, actually.
The one thing he couldn't bear to leave was his 6 sigmas.
Let's try zone 3.
My name is Warren Hayes. I'm from Chicago, Illinois. I understand from various publications like Outstanding Investor Digest that many of the best value investors are buying high-quality, multinational Japanese companies that are trading below net working capital value. Do you agree that these values exist in Japan, and would you consider the purchase? Do you agree that these values exist in Japan, and would you consider the purchase of some of them?
I will give a tout on it. I read the Outstanding Investors Digest, OID, and it's a very good publication. And I have read some of the commentary about Japanese securities. We've looked at securities in all major markets, and we certainly looked at them in Japan, particularly in recent years when the Nikkei has so underperformed the S&P here. We're quite a bit less enthused about those stocks as being any kind of obvious bargains than the people that you read about in OID. The returns on equity in most areas of Japanese business, returns on equity are very, very low, and it's extremely difficult to get rich by being the owner of a business that earns a low return on equity. We always look at what a business does in terms of what it earns on capital. We want to be in good businesses. What we really want to be is in businesses that are going to be good businesses and better businesses 10 years from now. And we want to buy them at a reasonable price. But many years ago, we gave up what I've labeled the cigar butt approach to investing, which is where you try and find a really kind of pathetic company, but it sells so cheap that you think there's one good free puff left in it. We used to pick up a lot of soggy cigar butts. I mean, I had a portfolio full of them, and there were soggy cigar butts. I mean, I had a portfolio full of them, and there were free puffs in them. And B, we don't find many cigar butts around that we would be attracted to. But those are the companies that had low returns on equity. And if you have a business that's earning 5 or 6% on equity, and you hold it for a long time, you are not going to do well in investing, even if you buy it cheap to start with. Time is the enemy of the poor business, and it's the friend of the great business. I mean, if you have a business that's earning 20 or 25% on equity, and it does that for a long time, time is your friend. But time is your enemy if you have your money in a low return business, and you may be lucky enough to pick the exact moment when it gets taken over by someone else, but we like to think when we buy a stock we're going to own it for a very long time, and therefore we have to stay away from businesses that have low returns on equity. Charlie?
Yeah, it's not that much fun to buy a business where you really hope this sucker liquidates before it goes broke.
We've been in a few of those too.
Right.
Yeah, Charlie and I, or at least I've owned stock in an anthracite, that don't know what anthracite is, street railway companies, windmill manufacturers. What other gems have we had, Charlie?
Textiles.
Yeah, textiles. Yeah, textiles. Don't even think. Yeah, Berkshire was a mistake, believe it or not. I mean, we went into Berkshire because it was cheap statistically, just as a general investment back in the early 60s. And it was a company that in the previous 10 years had earned less than nothing. I mean, it had a significant net loss over the previous 10 years. It was selling well below working capital, so it was a cigar butt. And it was, I mean, we could have done the things we've done subsequently from a neutral base rather than a negative base, and actually it would have worked out better. But it's been a lot of fun. Number 4.
Hello, my name is Martin Wiegand from Bethesda, Maryland. Again, I want to thank you for your letters and principles. They're a great help for small business people running their business. My question is, last year you said you had filters in your mind to help you quickly analyze businesses. How do your filters take into account the very fast changes of technology and the way that businesses communicate with their customers, take orders, things like that?
Well, we do have filters, and sometimes those filters are very irritating to people who check in with us about businesses, because we really can say in 10 seconds or so no to 90% plus of all the things that come in, simply because we have these filters. We have some filters in regard to people, too. But the question of technology is very simple. That doesn't make it through our filter. I mean, so if something comes in where there's a technological component that's of significance, or where we think the future technology could hurt the business as it presently exists, we look at, we look at that as something to worry about. It won't make it through the filter. We want things that we can understand, which filters out a lot of things, and we want them to be good businesses, and we want the people to be the people we're very comfortable with. That means ability and integrity, and we can do that very fast. We've heard a lot of stories in our lives, and it's amazing how you can become quite efficient in probably getting 95% of the ideas through in a very short period of time that should get through. Charlie?
Yeah, we have to have an idea that is A, good idea, and B, a good idea that we can understand. It's just that simple. And so those filters are filters against consequences from our own lack of talent.
Filters haven't changed much over the years either. Okay, area 5.
Hi, I'm Alan Maxwell. I live in the wonderful tropical island of Omaha.
Well, that's right up there with Exarban. That's Nebraska spelled backwards.
Everybody in this room's got to be wondering the same question. Who, in your opinion, both of you, is the next Warren Buffett?
Charlie? Who's the next Charlie Munger? Well, let's try that first. That's a more difficult question.
There's not much demand. I don't think there's only one way to succeed in life, and our successors in due time may be different in many ways, and they may do better.
Incidentally, we have a number of people in the company, some of whom are in this room today, and the ones you saw on that screen, who are leagues ahead of Charlie and me in various kinds of abilities. I mean, there's a lot of different talents. We've got a fellow in this room today who's the best bridge player probably in the world, and Charlie and I could work night and day, and if he spent 10 minutes a week working on it, he'd play better bridge than we would. And all kinds of intellectual endeavors that for some reason or another, one person's a little bit better wired for than someone else. And we have people running our businesses that if Charlie and I were put in charge of those businesses, we couldn't do remotely as well as they do. So there's a lot of different talents. The two that we're responsible for is keep able people who are already rich motivated to keep working at things where they don't need to do it for financial reasons. I mean, it's that simple. And And that's a problem any of you could think about. And you'd probably be quite good at it if you gave it a little thought, because you'd figure out what would cause you to work if you were already rich and didn't need the job. Why would you jump out of bed and be excited about going to work that day? And then we try to apply that to the people who work with us. Secondly, we have to allocate capital. And these days we have to allocate a lot more capital than we had to allocate a decade ago. That job is very tough at present. Sometimes it's very easy. And it will be easy at times in the future, and it'll be difficult at times in the future. But there are other people that can allocate capital, and we have them in the company. Charlie, you have any? No. Okay. Number 6.
Good morning. My name is Jad Corey. I'm from Gaithersburg, Maryland. I just want to thank you for sharing your wisdom. And my question is, what criteria do you use to sell stock? I kind of understand how you buy it, but I'm not sure how you sell.
Yeah. Well, the best thing to do is buy a stock that you don't ever want to sell. I mean, that's what we're trying to do. And that's true when we buy an entire business. I mean, we've bought all of Geico, or we bought all of See's Candy, or the Buffalo News. We're not buying those to resell. I mean, what we're trying to do is buy a business that we will be happy with if we own it the rest of our lives, and we expect to with those. It's the same principle applies to marketable securities. You get extra options with marketable securities. You can add to holdings, obviously easier. We can never own more than 100% of a business, but if we own 2% of a business and we like it at a given price, we can add and have 4 or 5%. So that's an advantage. Sometimes if we need money to move to another sector, like we did last year, we will trim from some holdings, but that doesn't mean we're negative on those businesses at all. I mean, we think they're wonderful businesses, or we wouldn't own them. And we would sell, if we needed money for other things. The Geico stock that I bought in 1951, I sold in 1952. It went on to be worth 100 or more times, before the 1976 problems, 100 or more times what I'd paid. But I didn't have the money to do something else. So you sell if you need money for something else. You may sell if you believe that valuations between different kinds of markets are somewhat out of whack. And we have done a little trimming last year in that matter. But that could well be a mistake. I mean, the real thing to do with a great business is just hang on for dear life. Charlie?
Yes, but the sales that do happen, the ideal way is when you found something you like immensely better. Isn't that obvious? That's the ideal way to sell.
And incidentally, the ideal purchase is to have something that you already like be selling at a price where you feel like buying more of it. I mean, we probably should have done more of that in the past in some situations. But that's the beauty of marketable securities. You really do. If you're in a wonderful business, you do get a chance periodically maybe to double up in it or something of the sort. If the stock market were to sell a lot cheaper than it is now, we would probably be buying more of the businesses that we already own. They would certainly be the first ones that we would think about. They're the businesses we like the best. Charlie?
Nothing more.
Okay, Zone 7.
Good morning, Mr. Buffett and Mr. Munger. My name is Ron Wright from Iowa City, Iowa. New companies have always been of interest to me. Is it reasonable to assume an Omaha-based company with only $5 billion in the bank might succeed in telecommunications?
Well, I think that a new company with $5 billion in the bank is probably better off than most new companies, but be like Jennifer Gates as a newborn. I think you're probably referring to a company that was created out of one of our local operations that's run by Walter Scott, one of our directors from the Kiewit Company, Level 3. I can tell you it's got very able management, and I'll take your word for it that it's also got fine, but you'll have to make your own judgment on the stock. I know Charlie won't comment on that one. Zone 8.
Yes, good morning. This is Mo Spence from Omaha, Nebraska. In the past, you've often said that the insurance operation is the most important business in Berkshire's portfolio. Is that true? And what are numbers 2 and 3? I'd also like to ask, is it true that Charlie chose the colors for the cover of this year's annual report?
Did Charlie chose them? He had nothing to do with them. I chose them. They're a tribute to the Nebraska football team and Tom Osborne, who you saw. Tom, incidentally, has a very low-key style, and Bobby Bowden a few years ago was in Lincoln, and he said that on their first date that Nancy had to slap Tom 3 times, and somebody said, "Was he that fresh?" And she said, "No, I was just checking to be sure he was alive." Tom had a fairly conservative offense for a time in the past, although it hasn't been so conservative the last few years. But somebody said at that time the most reckless thing he did was to eat some cottage cheese a day after the expiration on the carton. But I chose the colors. Now, what was the question? What was the question, Charlie? You remember? A memorable question, but give it to us again. Are we back there in Zone 8? Oh, the numbers, yeah, sure. The question was about the insurance business, which we have said will be by far the most important business at Berkshire. We said that many, many years ago, and it's proven to be the case. It obviously got a big leg up when we purchased all of GEICO. Insurance, as far as the eye can see, will be by far the most significant business at Berkshire. And the question about 2 and 3, in terms of earnings, flight safety is the second largest source of earnings, but we don't really think of them that way. I mean, we do know our main business is insurance, but we really have a lot of fun out of all of our businesses. I mean, I have a great time out of Borsheim's yesterday, or at a Dairy Queen. So. It will be accident to some extent the second or third or fourth largest. That'll be determined by opportunity. We bid on certain businesses or negotiated on them that could have been very large businesses if they'd become part of Berkshire, and that'll happen again in the future. So we have no predetermined course of action whatsoever at Berkshire. We have no strategic planning department. We don't have any strategic plan. We react to what we think are opportunities, and if it's a business we can understand, and particularly if it's big, we would love to make it number 2. Charlie?
I also want to say proudly that we have no mission statement.
No. It's hard to think of anything that we do have, as a matter of fact. Yeah, we have never had I mean, I'm sure you all know this, we've never had a consultant, and we try to keep things pretty simple. We still have 12 people at headquarters. We have about 40,000 people that now work for Berkshire, and we hope to grow a lot, but we don't hope to grow at headquarters. Number 9.
Yes, my name is Patty Buffett, and I'm from Albuquerque, New Mexico.
I like your name.
Thanks. In your opinion, what effect will the year 2000 compliant issue have on the U.S. stock market and the global economy?
Well, I get different reports on 2000, but the main report I hear, I think, you wouldn't want to rely on me on this, but you could rely on our managers, and I think we're in good shape. It's costing us some money, but not huge amounts of money to be prepared for 2000. With companies in which I'm a director, I hear some reasonably good-sized numbers. Those numbers are in their annual reports and described as to the cost of compliance. But what I'm told by people that know a lot more than I do is that they think probably that the weakest link may be in government. Think that in terms of where they stand versus the commercial sector, in terms of reaching where they need to be by 2000 that there's some areas of both national and state and local governments and foreign government where they're really behind the curve. Now, that is not an independent judgment of mine, but somebody said you want to be very careful about making a phone call at 5 seconds before midnight at the Millennium because you may get charged for 100 years, you know. So it'll be interesting. I don't think it's going to affect Berkshire in any material way, and I certainly have a feeling that the world will get past it very easily. But it is expensive for some companies, and it's going to be very expensive for governments. Charlie?
Yeah, I find it interesting that it is such a problem. You know, it was predictable that the year 2000 would come.
Yeah. Yeah. Yeah, we decided that back in 1985, actually. We didn't welcome it, understand. That's not Berkshire's style, though. It is fascinating, isn't it, when you think about it, that a whole bunch of people with 160 IQs that could build up such a problem. But here we are, and that's why we stick with simple things. Number 10.
My name is Kristen Schramm. I'm from Springfield, Illinois, and I'm a proud shareholder of Berkshire Hathaway.
We're glad to have you here.
I've heard a little about your thoughts on trying to control campaign spending. Could you tell us more about your thoughts and efforts on this topic? Thank you.
I think it was campaign spending.
Oh, campaign spending. Yeah, I have joined something that Jerry Kohlberg, this is personal, this has nothing to do with Berkshire, but that Jerry Kohlberg has spearheaded, and it's taken a position, and there are probably 30 or so, mostly business people, taken a position against soft money, and also taken a position on very fast disclosure of campaign finance money, because I personally think that the arms race in terms of campaign spending by businesses, has just begun. I mean, it doubled in the last election, but political influence, and I don't mean that by buying a vote, but I mean just in terms of having a big ear in Washington or in other state capitals. Political influence has been an underpriced product in the past. I mean, the government is enormously important in this country to most companies. It was amazing how cheaply it could be, attention could be purchased, but the price is going up, and there will be an escalation, and I don't think it's easy if you're the manager of a business and you own 1/10 of 1% of it, and you're in a business that's heavily affected by government. I don't think it's very easy to tell your board of directors that you're going to take a hands-off approach. So I think legislation is needed in that arena, and there are over 100 campaign finance reform bills that have been introduced. Everybody wants to have their name on a bill, they just don't want to have it passed. And John McCain's been working hard on it, and it's something I think we have to come to grips with, because it's going to be a battle of the wallets for influence. And like I say, if I were running some other company and my competitors were spending money to get the attention of would-be legislators or actual legislators, it'd be very difficult to take some high and mighty position that I wasn't going to do it myself, and my board and my shareholders might ask me why I was taking that position. We are lucky, basically, to be in a business that's relatively unaffected by legislation, although we're going to pay a lot of tax this year. I said 2 years ago that it would only take 2,000 entities in the whole United States, businesses, individuals, any kind of entity, to pay the same amount of taxes as Berkshire, and that would take care of the entire budget. You'd need no Social Security taxes, you'd need no nothing. I think we're going to be able to say that again this year. I think that if you multiply our tax by 2,000, you will more than account for, including Social Security and everything else. So you might say, why aren't you in Washington lobbying for a capital gains rate at corporations it's the same as individuals or something, but we basically haven't played that game. We feel very fortunate. I'll say this, I would rather in this country be a huge taxpayer myself than be somebody who needed the other end of it, the government dispensing. I mean, if anybody here is paying taxes and they want to, if you'd like to shift positions with somebody in a veterans hospital or that that has a couple of children by age 19 and is getting a check from the government, I don't want to shift positions. I'm happy to be paying the taxes. Zone 11, please. I think 11 is probably the remote. Yeah. So we're going to hear this from the overflow room. Are we there?
Yes. Good morning, Mr. Buffett, Mr. Munger. My name is Patrick Brown from Charlotte, North Carolina, and I've watched returns on equity for the banking sector in the U.S. go up a good bit over the last few years, and the returns on tangible equity for some of the major banks that have led the consolidation have gone up a good bit more. Leads me to wonder whether these returns are sustainable over either the near term or the longer term, 5-10 years out.
Well, that's the $64 question, because the returns on equity, and particularly tangible equity, as the gentleman mentioned, and particularly tangible equity in the banking sector even, those returns have hit numbers that are unprecedented. And then the question is, if they're unprecedented, are they unsustainable? Charlie and I would probably think that we would certainly prefer, we would not base our actions on the premise that they are sustainable. 20% plus returns on tangible equity, or on book equity, and much higher returns on tangible equity. In the banking field, you have a number of enterprises that on tangible equity are getting up close to the 30% range. Now, can a system where the GDP in real terms is growing maybe 3%, where in nominal terms it grows 4 to 5%, can businesses consistently earn 20% on equity? They certainly can't if they retain most of their earnings, because you would have corporate profits rising as a percentage of GDP to the point that would get ludicrous. So under those conditions, you'd either have to have huge payouts, either by repurchases of shares or by dividends or by takeovers, actually, that would keep the level of capital reasonably consistent among industry, or because you couldn't sustain, let's just say every company retained all of its earnings and they earned 20% on equity. You could not have corporate profits growing at 20% as a part of the economy year after year. This has been a better world than we foresaw in terms of returns, and so we've been wrong before, and we're not making a prediction now, but we would not want to buy things on the basis that these returns would be sustained. We told you last year, if these returns are sustained and interest rates stayed at these levels or fell lower, that stock prices are in aggregate are justified, and we still believe that. But those are two big ifs, and the particularly big if, in my view, is the one about returns on equity and on tangible assets. It certainly goes against classic economic theory to believe that they can be sustained. Charlie, how do you feel about it?
Well, I think a lot of the increase in return on equity has been caused by the increasing popularity of Jack Welch's idea that you can't be a leader in a line of business, get out of it. And as you get fewer people in the business, why returns on equity can go up. Then it's gotten way more popular to buy in shares, even at very high prices per share. And if you keep the equity low enough by buying shares back, why, you can make return on equity whatever you want. We've had, to some extent, a slow revolution in corporate attitudes. And but Warren is right. You can't have massive accumulations of earnings that are retained and keep earning these rates of return on them.
An interesting question is to think about it. If you had 500 Jack Welches and they were running the Fortune cloned and they were running all of the Fortune 500 companies, would returns on equity for American business be higher or lower than they are presently? I mean, if you have 500 sensational competitors, they can all be rational, but that doesn't, and they will be, and they'll be smart, and they'll keep trying to do all the right things. But there's a self-neutralizing effect. It's like having 500 expert chess players or 500 expert bridge players. You still have a lot of losers if they get together and play in a tournament. So it's not at all clear that if all American management were dramatically better, leaving out the competition against foreign enterprises, that returns on equity would be a lot better. They might very well drive things down. That's what, to some extent, can easily happen in securities markets. It's way better to be in securities markets if you have 100 IQ and everybody else operating has an 80 than if you have 140 and all the rest of them also have 140. So it's the secret of life is weak competition. Somebody said, how do you beat Bobby Fischer, and you play him any game except chess. Well, that's how you beat Jack Welch. You play him any game except business. Oh, he's a very good golfer, I want to point out. He shot a 69 a few months ago when I saw him at a very tough course. Jack manages to play 70 or 80 rounds of golf a year and come in subpar occasionally while still doing what he does at GE. He's a great manager. But 500 Jack Welches, I'm not at all sure would make stocks more valuable in this country. Zone 1.
I'm Ben Knoll, and I'm from Minneapolis. And first, I just wanted to thank you for providing your past annual letters to the shareholders, and Mr. Munger for providing your speech to the graduate students at the USC a couple years ago. Drawn a lot of insights from that, not only in investing, but also in my day job as a business manager. And I'm wondering if you could help me with my summer reading list and provide some additional suggestions for reading in the fields of investing and management, other than the standards of Graham and Fisher and so forth.
Charlie?
Yeah. I have recently read a new book twice, which I very seldom do. And that book is Guns, Germs, and Steel by Jared Diamond. And it's a marvelous book, and the way the guy's mind works would be useful in business. He's got a mind that is always asking why, and he's very good at coming up with answers. I would say it's the best work of its kind I have ever read.
I read a little easier book recently. I'm not even sure of the title. I don't pay much attention to titles when I get into the books, but it's something to the effect of the quotable Einstein. I mean, it's a lot of his commentary over the years, and it's great reading. The Fermat Theorem was the book. That isn't the exact title either, but it's the story of the discovery of the answer on that. That's a very interesting book. One of our shareholders from Sweden gave me a copy of that when I was in New York, and I've enjoyed it. Zone 2.
Mark Rabinoff, I'm shareholder from Melbourne, Australia. Gentlemen, we have large holdings in Freddie Mac and Fannie Mae, and as you both know, they were hurt quite a lot when interest rates went up in the past. I'm wondering if you think they'll be hurt again when interest rates go up in the future.
Well, the question about Freddie Mac and Fannie Mae and on interest rates, they are not as interest rate sensitive as people formerly thought they were, but it would be the pattern. I have a feeling that if interest rates got extremely low, so that there was a huge turnover of the portfolio, and then rates went up dramatically, that even though they have various ways of protecting themselves against interest rate scenarios, that might get very tough. I think there would be some kind of squeeze there. They may have good answers as to why that wouldn't happen, incidentally, because they certainly worry about every kind of interest rate scenario. That's their job. But I think, in a sense, very low interest rates are more of a long-term, because if you get a portfolio chock full of, say, 4% mortgages or something of the sort, and then you had a huge move upward, that would be quite painful for some period of time, no matter what you've done in the way of hedging. Charlie?
I've got nothing to add.
Yeah. That's what happened to the savings and loans, in effect, you see, 25 years ago or whenever it was. And Freddie and Fannie have other functions, and they've got a lot of advantages, but they have a savings and loan type operation. They just do it on a very big scale, and they get their money from in a very different manner than from millions of depositors. But the basic economics have some similarity. Zone 3.
Jane Bell, Des Moines. Since I became a Berkshire Hathaway shareholder, I've been coming to these meetings. This is my second.
I've been coming to these meetings ever since I've been a shareholder.
Mr. Buffett, I'm a partner and owner in a consulting business, and we tell our clients and potential clients that we design solutions for what keeps them awake at night. Mr. Buffett, from your perspective as an investor, what keeps you awake at night?
Well, that's a good question, and that's one I always ask the managements of our subsidiaries as well as any new investment. I want to know what their nightmare is. Andy Grove, in his book Only the Paranoid Survive, talks about the silver bullet for a competitor. So in terms of if you only had one silver bullet, which competitor would you fire it at? And it's not a bad question, and your question's a little broader. If you only had one worry that you could get rid of, what would it be? I would say that and I think I speak for Charlie, I'll let him do it, but we really don't worry. We will do the best we can, and when we have capital allocated, sometimes it's very easy to do, sometimes it's almost impossible to do, but we're not going to worry about it because the world changes, and if we had something we were worried about in the business, we would correct it. I'm not worried about anything. I'm not really worried about we can lose $1 billion on a California earthquake, but I'm not worried about it. Although I have a sister who's in the audience that lives in California. I've told her to call me quickly if the dogs start running in circles or anything like that. But there's if you're worried about something, the thing to do is get it corrected and get back to sleep. And I can't think of anything I'm worried about at Berkshire. That doesn't mean that I have any good ideas as to what we should be doing with a whole lot of money that we have around. But I can't do anything about that except keep looking for things that I might understand and do something with the money. And if they aren't there, they aren't there, and we'll see what happens tomorrow and next week and next month and next year. Charlie, what are you worried about?
Well, in the 30-some years I've been watching you, I would say what it takes to make you not sleep at night is an illness in the family. Short of that, Warren likes the game. I like the game. And even in the periods that look tough to other people, it's a lot of fun.
It's a lot of fun.
It's a lot of fun.
In fact, it probably is the most it is the most. I mean, we define tough times differently than other people would, but our idea of tough times is like now, and our idea of we don't feel it's tough times when the market's going down a lot or anything of the sort. So we are having a good time then. I mean, we don't want to sound like undertakers during a plague or anything, but there's really, it makes no difference to us whether the price of Berkshire is going up or down. We're trying to figure out ways to make the company worth more money years down the road, and if we figure that out, the stock will take care of itself. So, and usually when the stock is going down, it means other things are going down, and that it's a better chance for us to deploy capital, and that's our business. So you will not see us worrying. And maybe we should. What may worry? No, Zone 4.
My name is Phil Yoon from LA, California. Mr. Warren Buffett, Mr. Charlie, I'm one of the persons who highly admire you both. I have two questions. Question one, your view on world financial business environment in the next decade. Question two, U.S. position for economic competition in the next decade. Thank you.
Well, you've asked two big questions, but you're going to get very small answers, I'm afraid. And that's no disrespect, but we don't think about those things very much. We just are looking for decent businesses, and incidentally, our views in the past wouldn't have been any good on those subjects. And we try to think about two things. We try to think about things that are important and things that are knowable. Now, there are things that are important that are not knowable. In our view, those two questions that you raised fall in that. There are things that are knowable but not important. We don't want to clutter our minds up with those. So we say, what is important and what is knowable? And what among the things that fall within those two categories can we translate into some kind of an action that is useful for Berkshire? And we really, there are all kinds of important subjects that Charlie and I, we don't know anything about. And therefore we don't think about them. So we have our view about what the world will look like over the next 10 years in business or competitive situations. We're just no good. We do think we know something about what Coca-Cola is going to look like in 10 years, or what Gillette's going to look like in 10 years, or what Disney's going to look like in 10 years, or what some of our operating subsidiaries are going to look like in 10 years. We care a lot about that. We think a lot about that. We want to be right about that. If we're right about that, the other things get to be, they're less important. And if we started focusing on those, we would miss a lot of big things. I've used this example before, but Coca-Cola went public in, I think it was 1919. And the first year, one share cost $40. The first year it went down a little over 50%. At the end of the year it was down to $19. There were some problems with bottler contracts, there was problems with sugar, various kinds of problems. If you'd had perfect foresight, you would have seen the world's greatest depression staring you in the face when the social order even got questioned. You would have seen World War II, you would have seen atomic bombs and hydrogen bombs. You would have seen all kinds of things. And you could always find a reason to postpone why you should buy that share of Coca-Cola. But the important thing wasn't to see that. The important thing was to see that they were going to be selling 1 billion 8-ounce servings of beverages a day this year, or some large number. And that the person who could make people happy 1 billion times a day around the globe ought to make a few bucks off doing it. And so that $40, which went down to $19, I think with dividends reinvested has to be well over $5 million now. And if you develop the view on these other subjects that in any way forestalled you acting on this more important, specific, narrow view about the future of the company, you would have missed a great ride. So that's the kind of thing we focus on. Charlie?
Yeah, we're not predicting the currents that will come, just how some things will swim in the currents, whatever they are.
Zone 5, please.
Good morning. Mark Gerstein from Value Line. Mr. Buffett, considering the large amount of demands on your time, how do you go about reviewing the entire spectrum of choices in the equity markets?
Give me that last part again. I got the demands on my time. And
how do you and Mr. Munger manage to review the whole spectrum of choices in the equity markets?
A bad pitch coming up. But I don't mind it at all, because the truth is that we get, I don't know what we even pay for Value Line. Charlie and I both get it, but in our respective offices, but we get incredible value out of it because it gives us the quickest way to see a huge number of the key factors that tell us whether we're basically interested in the company. It also gives us a good way of sort of periodically keeping up to date. Value Line has 1,700 or so stocks they cover, and they do it every 13 weeks. So it's a good way to make sure that you haven't overlooked something if you just quickly review that. But the snapshot it presents is an enormously efficient way for us to garner information about various businesses. We don't care about the ratings. I mean, that doesn't make any difference to us. We're not looking for opinions. We're looking for facts. But I have yet to see a better way, including fooling around on the internet or anything that gives me the information as quickly. I can absorb the information about a company. Most of the key information you can get in probably doesn't take more than 30 seconds in glancing through Value Line, and I don't have any other system that's as good. Charlie?
Well, I think the Value Line charts are a human triumph. It's hard for me to imagine a job being done any better than is done in those charts. An immense amount of information is put in very usable form. And if I were running a business school, we would be teaching from Value Line charts.
And when Charlie says the charts, he does not mean just the chart of the price behavior. He means all that information that really is listed under the charts that gives the detailed financial information. You can run your eye across that. The chart of the price action doesn't mean a thing to us, although it may catch our eye just in terms of businesses that have done very well over time. But price action has nothing to do with any decision we make. Price itself is all important, but whether a stock has gone up or down, or what the volume is, or any of that sort of thing, that is, as far as we're concerned, those are chicken tracks, and we pay no attention to them. But that information that's right below the chart, in those 10 lines or so, 15 lines, if you have some understanding of business, it's a perfect snapshot to tell you very quickly what kind of a business you're looking at. Zone 6, please.
David Winters from Mountain Lakes, New Jersey. With the consolidation in the insurance industry, how do you think that will affect Berkshire's insurance businesses and the long-term development of the float? And if I may, not to encourage your dogma to run over your karma, but how do you think your policy of partnership and fair dealing has enhanced or detracted from your investment returns? Thank you.
Well, the consolidation taking place in insurance has been taking place for some time. There have been some big mergers over the years. There are developments in insurance. We mentioned the super cat bonds, which are not bonds at all, but that has an effect. But I would say that there's no merger that has taken place that I regard as being detrimental either to our GEICO business or to our reinsurance business. That has not been a factor, and I think if there were some more mergers, it would not be a factor. I see no way that any entities being put together would change the competitive situation in respect to GEICO. GEICO, operating just as it does independently, is as competitive as can be, and it would not benefit by being part of any other organization. And our reinsurance business is much more opportunistic, and it's not consolidation there. It's just lack of fear generally by competitors who can price particularly cat business at a rate that could be totally inadequate, as I used an illustration in the report, but nevertheless it could appear to be profitable for a long time. And there's probably more of that going on now, and there'll probably be a lot more going on in that arena. We have some sensational insurance businesses, though. I have to tell you that I don't think you really have to worry too much about how we do in insurance in the future. We had a number of GEICO people here today. I hope you got a chance to meet them. GEICO, and you saw Lorimer Davidson. I really was hoping he could be here, but Davey is 95 years old. I went to visit him a few months ago, and it just isn't easy for him to get around. But he built a sensational company, and it stumbled once. Jack Byrne got it back on track, and Tony Nicely's got it going down the track at about 100 miles an hour, and it's getting faster all the time. So we've got a great business there. Charlie?
Nothing to add.
Zone 7.
Yes, Bill Ackman from New York. Is there a price at which it's inappropriate for a company to use its capital to buy back its stock?
Give me that again.
For example, Coca-Cola at 40 PE. Is that a smart place for Coke to deploy capital?
Well, it sounds like a very high price when you name it in terms of a PE to buy back the stock at that sort of number. But I would say this. Coca-Cola's been around 112 years now, and there are very few times in that 112 years, if any, when it would not have been smart for Coca-Cola to be repurchasing its shares. Coca-Cola is probably, in my view, among businesses that I can understand, it's the best large business in the world. I mean, it is a fantastic business, and we love it when Coke repurchases shares and our interest goes up. We owned 6.3% of Coca-Cola in 1988 when we bought in. We actually increased that a little bit a few years later. But if they had not repurchased shares, we probably would own about 6.7% or 6.8% of Coke now. As it is, we own a little over 8% through repurchases. There are going to be about 1 billion 8-ounce servings of Coke sold around the world, or Coca-Cola products sold around the world today. 8% of that is 80 million, and 6.8% is 68 million. So there are 12 million extra servings for the account of Berkshire Hathaway being sold around the world. And they're making a little over a penny a serving, so, you know, that gets me kind of excited. And I think all I can tell you is I approve of Coke repurchasing shares. I'd a lot rather have them repurchasing shares at 15 times earnings, but when I look at other ways to use capital, I still think it's a very good use of capital. And maybe the day will come when they can buy it at 20 times earnings, and if they can, I hope they go out and borrow a lot of money to buy a ton of it at those prices. And I think we will be better off 20 years from now if Coke follows a consistent repurchase approach. I do not think that is true for many companies. I mean, I think that repurchases have become in vogue and done for a lot of silly reasons. And so I don't think everybody's repurchase of shares is well reasoned at all. You know, we see companies that issue options by the ton and then they repurchase shares much higher. You know, I started reading about investments when I was 6, and I think the first thing that I read was, you know, buy low, sell high. But these companies, through their options, you know, they sell low and then they buy high, and they've got a different formula than I was taught. So there are a number that we don't approve of. But when we own stock in a wonderful business, we like the idea of repurchases even at prices that may give you nosebleeds. It generally turns out to be a pretty good policy. Charlie?
Well, I think the answer is that in any company, the stock could get to a price so high it would be foolish for the corporation to repurchase its shares.
Sure.
And you can even get into gross abuse. Before the crash, the Insul utilities were madly buying their own shares as a way of promoting the stock higher. It was like a giant Ponzi scheme at the end. So there's all kinds of excess that's possible, but the really great companies that buy at high price earnings, that can be wise.
Our interest in Geico went from 33% to 50% without us laying out a dime, because Geico was repurchasing its shares. And we benefited substantially, but we benefited a lot more, obviously, when prices were lower. I mean, our interest in the Washington Post company has gone from 9.5% to 17.5% over the years without us buying a single share. But the Post or Coke or any number of companies don't get the bargain in repurchasing now that they used to. We still think it's probably the best use of money in many cases. Zone 8.
My name is Hutch Vernon. I'm from Baltimore, Maryland. My question has to do with float You said in the annual, and you've said in the past, that float has had a greater value to Berkshire than an equal amount of equity. And I wondered if you could clarify that statement. Is that because the float has been generated at such a low cost relative to an imputed cost for equity, or is there something else behind that statement?
No, it's because the float, which is now, we'll say, $7 billion, comes to us at a negative cost. We would not make that statement if our float was costing us a couple percent a year, even though float would then be desirable, highly desirable. But our float is even better than that, or it has been, and so it comes to us with a cost of less than zero. It comes to us with a profit attached. So if we were to get out of the insurance business and give up the $7 billion of float and replace it with $7 billion of equity, we would have less going for us next year than under the present situation, even though our net worth would appear to be $7 billion higher. And I have said that if we were to make the decision, if we were offered the opportunity to go out of the insurance business and that $7 billion liability would, as part of that decision, would evaporate from our balance sheet so that our equity would go up $7 billion with no tax implications, we would turn down that proposition. So obviously we think that $7 billion, which is shown as a liability, when it's viewed as part of an insurance business, is not a liability at all in terms of real economic value. And of course the key is not what the float is today and not what the cost is today. The key is what is the float going to be 10 or 15 years from now, and what is the cost going to be 10 or 15 years ago. And we will work very hard at both increasing the amount of float and keeping the cost down somewhere close to our present level. That makes it a very attractive business when that can be done. GEICO's a big part of of doing that, but we've got other things, other insurance operations that'll be important in that too, and we may have others besides that in the future. Charlie?
Yeah, if the float keeps growing, that is a wonderful thing indeed. We really have a marvelous insurance business. In addition to having this remarkable earning power, it's way less likely to get really clobbered than most insurance businesses. So I think it's safer on the downside and has a better upside.
And it may sound strange, but we don't regard losing $1 billion in the California quake as getting really clobbered. I mean, that's part of the game. There are many companies that have greater exposures than that really aren't getting paid for it. And you don't see it specifically, but any company that has a ton of homeowners business in Florida or Long Island or along the coast of Texas may have exposures many times our billion, and really exposures many times our billion, and really not be getting paid appropriately or specifically. Zone 9.
Hi, my name is Mary Semler from Seattle, Washington. Japan is a major holder of U.S. Treasuries. Given the troubled Japanese economy, do you foresee Japan cashing in their U.S. investments to bail themselves out? Why or why not?
Sorry, I didn't get all that.
I didn't get that either.
I was busy chewing here, but
Japan is a major holder of U.S. Treasuries. Given the troubled Japanese economy, do you foresee Japan cashing in the U.S. investments to bail themselves out? Why or why not?
The problems with the Japanese economy, and does that mean that are you thinking particularly about them dumping treasuries or something of the sort?
That's exactly what she's...
Yeah. Well, it's very interesting. All the questions about what so-called foreigners do with investments. Let's just assume the Japanese or any other country decides to sell some U.S. government holdings that they have. If they sell them to U.S. corporations or citizens or anything, what do they receive in exchange? They receive U.S. dollars. What do they do with the U.S. dollars? They can't get out of the system. If they sell them to the French, the French give them something in return. Now the French own the government securities. But really, as long as we, the United States, run a deficit, a big deficit, a trade deficit, we are accepting goods and giving something in exchange to foreigners. I mean, when they send us whatever that it may be, and on balance they send us more of that than we send over there, we give them something in exchange. We may give them an IOU, we may give them a government bond, but we may give them an investment they make in the United States. But they have to be net investors in this country as long as we're net consumers of their goods. It's a tautology. So I don't even know quite how a foreign government dumps its government bonds without getting some other type of asset in exchange that may have an effect on a different market. The one question you always want to ask in economics is, and not a bad idea elsewhere too, but is, and then what? Because there's always a second side to a transaction. And just ask yourself, if you are a Japanese bank and you sell $1 billion worth of government bonds, U.S. government bonds, what do you receive in exchange? And what do you do with it? And if you follow that through, I don't think you'll be worried about foreign governments selling U.S. bonds. It is not a threat. Charlie?
If I owned Japan, I would want a large holding of U.S. Treasuries. You're on an island nation without much in the way of national resources. I think their policy is quite intelligent for Japan, and I'd be very surprised if they dumped all their treasuries.
If they're a net exporter to us, though, what choice do they have? I mean, think about it. If they send over more goods to us than we send to them, which has been the case, they have to get something in exchange. Now, for a while, they were taking movie studios in exchange. You know? They were taking New York real estate in exchange. I mean, they've got a choice of assets, but they don't have a choice as to whether, if they can send us more than they get from us, whether they get some investment asset in return. I mean, it's amazing to me how little discussion there is of that, the fact that there's two sides to an equation. But it makes for better headlines when read the other way. Zone 10.
This is John Bond from Detroit, Michigan. Nebraska's Senator Kerry has proposed private investment accounts for up to 2 percentage points of the current payroll tax. His words were, and I quote, "People want more than just a transfer payment, they want wealth." Do you approve this proposal? And if you do, would you recommend passive investing, i.e. index? Or if you recommend active investing, would you and Charlie want to give it a shot?
Well, I've talked with Bob Kerry about that, and Bob does like the idea of giving everybody some piece of the American economy and an interest in it. He's thought, as you know, he's proposed really sort of small grants to the 3.5 million or so children born every year, and then some buildup of that account. Senator Moynihan has come up with something recently in conjunction with Kerry. I personally would not like to see any major amount of Social Security, and Moynihan is talking about 2%, and I suggested the idea that maybe 2% out of the 12 and a fraction percent at the option of the beneficiary, Social Security participant, could be devoted to some other system, but then they would only get 5/6 of the basic Social Security benefit. I don't think you could drop it below that, because you wouldn't want people turning 65 or maybe more advanced age in the future, 70, and not having the safety net of Social Security. So I wouldn't want to drop it below about 5/6 of the present benefits. I think it's a perfectly reasonable topic to discuss whether you want to take that 2% then and let people build up an account, perhaps tax-free, perhaps an IRA type account, so they would have both wealth and the safety net. But I wouldn't want to drop the safety net very far. And I think that I would not want to turn an army of salespeople loose on the American public with a mandatory 2% going in some direction. I don't think that would be particularly healthy. Charlie?
I'm much less enthusiastic than you are. In other words, your negative or conservative attitude is way more affirmative than mine. I think the idea of getting the government into promoting the value of equities, in Japan we have a taste of that now. The Japanese government has been using the postal savings system to buy equities massively year after year after year. I don't think we need to get the government into the equity market.
We go to zone 11, please.
I'm Dale Max from University Park, Illinois. And I've got a question for each of you, a short question for Charlie, and maybe a little longer for Warren. My question for Charlie is, in a business school sense, what is the cost of capital for Berkshire Hathaway? And my question for Warren is that I've been on the internet and I look at Yahoo and they give you recommendations for companies. And when I search for Berkshire Hathaway, it shows that nobody is recommending Berkshire Hathaway, despite the fact that there are maybe 1,000 people that are wearing signs here. I love Berkshire Hathaway, and of course I've got mine on too, but what seems to be the problem in lack of recommendations?
Well, we're not recommending Yahoo, incidentally, either, but but I'll let puzzle people for thousands of years, and then
the way that is taught in most business schools now, I find incoherent, and so I'm the one that asks that question and gets the incoherent answers. I don't have a good answer to a question I consider kind of a stupid question. What is the cost of capital at Berkshire Hathaway when we keep drowning in this torrent of cash?
To get to that, but you don't need a mathematical answer. The first question is when you have capital, is it better to keep it or return it to shareholders? It's better to return it to shareholders when you cannot create more than $1 of value with that capital. That's test number one. And if you pass that threshold that you think you can achieve more than $1 of value for every dollar retained, then you simply look around for the thing that you feel the surest about and that promises the greatest return, weighted for that certainty. So our cost of capital is, in effect, is measured by the ability to create more than $1 of value for every dollar retained. If we're keeping dollar bills that are worth more in your hands than in our hands, then we've exceeded the cost of capital as far as I'm concerned. And once we think we can do that, then the question is how do we do it to the best of our ability? And frankly, all of the stuff I see in business schools, and I've not found any way to improve on that formula. Now, the trouble that you may have is that many managements would be reluctant to distribute money to shareholders, even if they would rationalize that they would do better than they then actually do. But that may be a danger on it, but that won't be solved by them hiring a bunch of people to come up with some cost of capital that also justifies them keeping the money, because that's what they'll do otherwise. The question about recommending the stock, we've very seldom had stock recommendations over the years. As I think back to 1965, I can't think of a lot of brokerage reports that have recommended Berkshire. I'm not looking for any, reports at all. We are not looking to have Berkshire sell at the highest possible price, and we're not looking to try and attract people to Berkshire who are buying stocks because somebody else recommends them to them. We prefer people who figure out for themselves why they themselves want to buy Berkshire, because they're much more likely to stick around if they enter the restaurant because they decide it's the restaurant they want to eat at than if somebody has touted them on it. And that's our approach. So we do nothing to encourage, but I think even if we did, we probably wouldn't generate a lot of recommendations. It's not a great stock to get rich on if you're a broker.
Yeah, I think the reason. I think one of the main reasons why it's so little recommended in the institutional market is that it's perceived as hard to buy in quantity.
We prefer, we've got some good institutions as holders, including one that's run by a very good friend of ours, but frankly, it's more fun for us to have a bunch of individual shareholders. I mean, you see it translates, if there's money made, it translates into changes in people's lives and not some change in somebody's performance figure for one quarter. And we think that individuals are much more likely to join us with the idea of staying with us for as long as we stay around. And you know, that's the way we look at the business. Very few institutions look at investments that way, and frankly, we think they're often less rational holders than we get with individuals. Number one.
Good morning. Good morning, gentlemen. I'm Hugh Stevenson, a shareholder from Atlanta. My question involves the company's SuperCat reinsurance business. You've addressed some of this, but I would like for you to expound on it, please. You've indicated that you think this is the most important business of the company. And my question is what you think the long-term impact of catastrophe bonds and is what you think the long-term impact of catastrophe bonds and catastrophe derivatives will be on the float and the growth in float of the company affect the way you price your business. But I'm wondering how you think it can affect the volume of the business. And I remember several years ago, Mr. Buffett, you talk about you can never be smarter than your dumbest competitor.
Right.
And these are some potentially dumb competitors.
You've got it. I just want to put an asterisk on one thing. We say insurance will be our most important business. We've not said the SuperCat business will be our most important. SuperCat has been a significant part of our business and may well over the years remain a significant part, but it is far less significant than GEICO, and I'll mention a word or two about that. But the SuperCat business, you can price wrong, as I illustrated in my report. You can be pricing it at half what it should be priced at. I used an illustration in the report of how you could misprice it, a policy that you should be getting, say, $1.5 million for, namely a $50 million policy on writing on something that had one chance in 36 of happening. So you should get almost $1.5 million for it. I said if you priced it at $1 million a year, you know, you would think you were making money after 10 years, 70-odd% of the time. The interesting thing about that is if you priced it for $1 a year, you would have thought you made money 70-odd% of the time, because when you are selling insurance against very infrequent events, you can totally misprice them but not know about it for a long time. SuperCat bonds open up that field wide open. I mean, you've always had the problem of dumb competitors, but you have a much more chance of having dumb competitors when you have a whole bunch of people who, in the case of hedge funds who have bought some of these, where the manager gets 20% of the profits in the year when there are profits and there is no hurricane, and when there happens to be a hurricane or an earthquake, he doesn't take the loss as limited partners do. So it's very likely to be a competitive factor that brings our volume down a lot. It won't change our prices. You know, the thing to remember is the earthquake does not know the premium that you receive. I mean, the earthquake happens regardless. So it doesn't say, you know, you don't have somebody out there on the San Andreas Faults that says, well, he only charged a 1% premium, so we're only going to do this once every 100 years. It doesn't work that way. So we will probably do a whole lot less volume in the next few years in the SuperCat business. We have these two policies that run for a couple of more years. But in terms of new business, we will do a whole lot less. GEICO is by far the most important part of our insurance business, though. GEICO in the 12 months ended April 30th had a 16.9% increase in policies in force. Year end, I told you it was 16.0. A year ago, I told you it was 10. The year before that, I think it was 6 and a fraction. So its growth is accelerating, and it should be in a whole lot more homes around the country than it is now, you know, by a big factor, and it will be, in my view. So that will be the big part of our insurance business. But we may be in the insurance business in some other ways too, as time goes along. It's a business that if you exercise discipline, you should find some ways to make money, but it won't always be the same way. Charlie?
I've got nothing to add.
Okay, zone 2.
Hello, I'm Steve Davis from San Francisco. I'd like your advice on how to understand annual reports, what you look for, what's important, what's not important, and what you've learned over the years from reading thousands of reports. Thank you.
Well, we've read a lot of reports, I will tell you that. And we start by looking at the reports of companies that we think we can understand. So we hope to be reading reports, and I do read hundreds of them every year. We hope to be reading reports of businesses that are understandable to us. And then we see from that report whether the management is telling us about the things that we would want to know about if we owned 100% of the company. And when we find a management that does tell us about those things and that is candid in the same way that a manager of a subsidiary would be candid with us and talks in language that we can understand, it definitely improves our feeling about investing in such a business, it definitely improves our feeling about investing in such a business, and the reverse turns us off to some extent. So if we read a bunch of public relations gobbledygook, it has some effect toward a business. We want to understand the business better when we get through with the annual report than when we picked it up. And that is not difficult for a management to do if they want to do it. If they don't want to do it, we think that is a factor in whether we want to be their partners over a 10-year period or so. But we've learned a lot from annual reports. For example, I would say that the Coca-Cola annual report over the last good many years been an enormously informative document. I mean, I can't think of any way if I had had a conversation with Roberto Goizueta or now Doug Ivester, and they were telling me about the business, they would not be telling me more than I get from reading that annual report. We bought that stock based on an annual report. We did not buy it based on any conversation of any kind with the top management of Coca-Cola before we bought our interest. We simply bought it based on reading the annual report, plus our knowledge of how the business worked. Charlie?
Yeah, I do think if you've got a standardized bunch of popular jargon that looks like it came out of the same consulting firm, I do think it's a big turnoff. That's not to say that some of the consulting mantras aren't right, but I think there's a lot for sort of candid, simple, coherent prose. A lot to be said for it.
Almost every business has problems, and we just assume the manager would tell us about them. We would like that in the businesses we run. In fact, one of the things, we give very little advice to our managers, but one thing we always do say is to tell us the bad news immediately, and I don't see why that isn't good advice for the manager of a public company. Over time, I'm positive it's the best. I'm positive it's the best policy, but a lot of companies, they're dying just to pump out what they think is good news all the time, and they have this attitude that that you've got a bunch of animals out there to be fed, and that they're going to feed them what they want to eat all the time. And over time, the animals learn. So we try and stay away from businesses like that.
What you seldom see in an annual report is a sentence like this: "This is a very serious problem, and we haven't quite figured out yet how to handle it." But believe me, that is an accurate statement much of the time. All right, zone 3.
I'm Larry Dirks, and I live in the area, and I would like to know what your prediction is for Coca-Cola's long-term growth versus Pepsi-Cola's recent efforts to increase their competitiveness with Coke.
Yeah. Long term, I would expect Coke to continue to gain versus Pepsi.
has he been doing while I was gone? What'd you say, Charlie? I knew I was taking a chance. What was the question?
I said that long term I expected Coke to continue to gain versus Pepsi.
Oh, well, it's those kind of insights is why we keep him on the job year after year. In a moment of particular confidence, he one time told me the same thing about RC. That was probably zone 3 you were answering, so we'll go to 4. What have you got there? You got peanut brittle? Zone 4, please.
Jason, Houston, Texas. My first question's on the quality of earnings and your evaluation of quality of earnings in the U.S. right now. And the second is what multiples should be put on asset gains, such as sale of bottling assets or reversal of merger reserves. Thanks.
Yeah, well, taking the second question, for example, at Coca-Cola, where the bottling transactions are incidental to a long-term strategy, which, in my view, has been enormously successful to date and which has more successes ahead of it. But in the process of rearranging and consolidating the bottling system and expanding to relatively undeveloped markets, there have been and there will be a lot of bottling transactions, and some produce large gains, some produce small gains. I ignore those in my evaluation of Coke. The two important elements in Coke are unit case sales and shares outstanding. And if the shares outstanding go down and the unit case sales advance at a good clip, you are going to make money over time in Coca-Cola. There have been transactions where people have purchased rights to various drinks. Coca-Cola's purchased some of those around the world. And when you see what is paid for 1 million or 100 million unit cases of business, and then you think to yourself that maybe Coke will add a 1.5 billion cases a year, that's a real gain in value. It's a dramatic gain in value, and that is what counts in terms of the Coca-Cola Company. If you think the Coca-Cola Company is going to sell some multiples of its present volume 15 or 20 years from now, and you think there'll be a lot fewer shares outstanding, you've gone about as far as you need to go. But I would pay no attention to asset gains. I would just take those out of the picture. Now, as to quality of earnings, Charlie and I feel that in several respects, but in one important respect, that the quality of earnings has gone down, not because the policy has changed, but because it's just become more significant, and that's in the case of stock options. There are certain companies that we've evaluated for possible purchase where in our calculation of earnings, the earnings are maybe 10% less per year, per share, than reported. And that isn't necessarily the end of the world, but it is a difference in valuation that is significant and is not reported under standard accounting. So we think the quality of earnings as reported by a company with significant stock option grants every year, we think is dramatically poorer than one where that doesn't exist. And there are a lot of companies that fall in that category. Coca-Cola's earnings are very easy to figure it out. Just figure out what they're earning per case from operations, and you'll see over the years the earnings per case go up, and the cases go up, and the shares go down. And it doesn't get much more complicated than that. Charlie?
You've said it wonderfully. I just wish we had more like that.
Yeah. GEICO, the key, the same way as policies in force and underwriting experience per policy. And that is exactly the way, as noted in the annual report, we pay people there. We pay them from the bottom to the very top based on what happens with those two variables. And we don't talk about earnings per share at GEICO, and we don't talk about investment income. We don't get off the track because there are two things that are going to determine what kind of business that GEICO is over a long period of time. And policies at GEICO are unit cases at Coca-Cola. Zone 5.
Hello, Mr. Buffett and Mr. Munger. My name is James Claus from New York City, and I just wanted to ask you a question. Both you and Mr. Munger have repeatedly said that you don't believe that business valuation is being taught correctly at our universities. And as a PhD student at Columbia Business School, that troubles me understandably, because in a couple of years I'll be joining the ranks of those teaching business valuation. My question isn't what sources such as Graham or Fisher or Mr. Munger's talks you would point people that are teaching business valuation to, but do you have any counsel about the techniques of teaching business valuation?
Well, I was lucky. I had a sensational teacher in Ben Graham, and we had a course there. There's at least one fellow out in the audience here that attended with me, and just Ben made it terribly interesting, because what we did was we walked into that class and we valued companies. And he had various little games he would play with us. Sometimes he would have us evaluate company A and company B with a whole bunch of figures, and then we would find out that A and B were the same company at different points in its history, for example. And there were a lot of little games he played to get us to think about what were the key variables, and how could we go off the track. I remember one time Ben met with Charlie and me and about 9 or so other people down in San Diego in 1968 or so, and he gave all of us a little true-false test, and we all thought we were pretty smart, and we all flunked. But that was his way of teaching us that a smart man playing his own game and working at fooling you could do a pretty good job at it. But I would, if I were teaching a course on investments, there would be simply one valuation study after another with the students trying to identify the key variables in that particular business and evaluating how predictable they were first, because that is the first step. If something is not very predictable, forget it. You don't have to be right about every company. You have to make a few good decisions in your lifetime. But then when you find, the important thing is to know when you find one where you really do know the key variables, which ones are important, and you do think you've got a fix on them. Where we've done well, Charlie and I made a dozen or so very big decisions relative to net worth, but not as big as they should have been. And we've known we were right on those going in. I mean, they just weren't that complicated, and we knew we were focusing on the right variables and that they were dominant. And we knew that even though we couldn't take it out to 5 decimal places or anything like that, we knew that in a general way we were right about them. And that's what we look for, the fat pitch. And that's what I would be trying to teach students to do. And I would not try to teach them to think they could do the impossible. Charlie?
Yes, if you're planning to teach business valuation, and what you hope to do is teach the way people teach real estate appraising. So you can take any company, and your students, after studying your course, will be able to give you an appraisal of that company, which will indicate really its future prospects compared to its market price. I think you're attempting the impossible.
Yeah, probably on the final exam, I would take an internet company, and I would say the final exam, the question is, how much is this worth? And anybody that gave me an answer, I would flunk.
Right.
Make grading papers easy, too. Okay, Zone 6.
Good morning. Lawrence Balter, Carlsbad, California. Question for the two of you. There was an article, I think about last year in the New York Times that regarded Wesco as a Berkshire Class C share type company. And I'd like to know your comments on that. And the second question is, if I were to write you a check for the operating businesses that Berkshire owns, how much would it have to be?
Big. Charlie is the resident expert on Wesco, so I'm going to let him address that subject. He gets very eloquent on this.
Yeah, we always say that per unit of book value, Wesco is worth way less than Berkshire, and indeed the market is saying the same thing. It is not a clone of Berkshire. It's a historical accident.
We want to do well, obviously, for Wesco. We own 80% of it, and we've got strong feelings about the people who are our partners there, particularly the Peters family, who, in effect, invited us in 20-odd years ago and trusted us to manage a big part of their money, in effect, by letting us buy control. So we've got strong fiduciary feelings about it. It suffers in comparison with Berkshire because, for one thing, anybody that wants a tax-free merger is going to want to come to Berkshire. That's just the way it is, unfortunately. And we are looking for big ideas primarily, and the big ideas are going to fit into Berkshire. We would love to get ideas that fit into Wesco, and we had a very good one a couple of years ago, thanks to Roy Dinsdale pointing me in the right direction. And we added Kansas Bankers Surety to Wesco, and it's a gem, and it's run by Don Toll, who's done a terrific job. But that's the exception, unfortunately, because if a flight safety comes along, it's not going to fit Wesco. So we will do our best for Wesco, but the nature of things is that most of the opportunities that make a lot of sense are going to come to Berkshire. Charlie, do you have anything?
Nothing more.
Okay, Zone 7.
My name is Bob Swanson from Phoenix, and I'm wondering, what are the advantages of investing in Berkshire Hathaway as opposed to investing in the stocks that Berkshire owns?
Well, a lot of people do one or the other, and some people do both, but you have to really make up your own mind on that. We're not going to go to great lengths to tell you about everything that Berkshire is doing as we go along, and there could be some changes, and there will be things that can happen in Berkshire that I think you would have trouble duplicating elsewhere. But on the other hand, if you'd put all your money in Coca-Cola some years back, you might have done better than if you put in Berkshire. So we really make no recommendation to what people do with their money. We do not seek to become investment advisors through, in effect, our portfolio actions at Berkshire. Charlie?
Basically, we hate it when people follow us around buying what we buy.
Nothing personal.
No. By the way, the questioner before this last one asked, what is the market value under the hammer of all Berkshire's operating subsidiaries? And the answer is, you have to figure that out yourself.
Mr. Nice Guy. But we give you the information, incidentally, where your judgment on that should be about as good as ours. There's nothing mysterious about valuing the Buffalo News or See's Candy or Flight Safety or Dairy Queen. So you really have the same information we have in that. I mean, if there's material information that we aren't giving you about any important Berkshire subsidiary, we'd like to give it to you because we think you are entitled to have the information that enables you to value the various pieces. Because of the aggregate size of Berkshire now in terms of market capitalization and some of the positions we own, the smaller subsidiaries really cannot have that much effect. We love them just as much. I enjoy all of the businesses we're in, and I enjoy the people that run them. So we don't we don't differentiate in our attitude within the company, but in terms of the actual impact on the valuation of Berkshire, there are a number that really they just don't make that much difference in terms of figuring out whether Berkshire's worth X or X minus 1,000 or plus 1,000, because 1,000 now is over $1 billion in terms of valuation. $1 billion is still a lot of money. Area 8, please.
Hello, Mr. Buffett, Mr. Munger. My name is Robert McCormick. I'm from Holdings, Nebraska, and I would like to know how much you attribute the gains enjoyed by the stock market these past years to the baby boomer generation investing for their retirement.
Yeah, I would say that personally, I would not think that has much to do with it. I think the two big factors well, there's three big factors. One is the improved return on equity, which was a fundamental factor that pushed stock prices up. Two is the decline in interest rates that pushed stock prices up. And then finally, stock prices advancing themselves brings in buying. It doesn't go on forever, but it creates its own momentum to some extent if you have these underlying factors that started to push it along. So I would say two of the three factors are fundamental, and the third is a market-type factor that bull markets do feed on themselves. And I think that you've seen some evidence of that. But I don't think that any specific, the 401k factor or whatever it may be was it by itself. But I do think money is pouring into mutual funds, for example, because people have had a very favorable experience with those funds. And that does bring investors along. People want to be on the train. Charlie? And I think, incidentally, many of them have very unrealistic expectations.
Yeah, the general investment experience in the last, 18 years in common stocks has been awesomely high, I think, by any past standards now. Isn't that right, Warren?
Right. Well, you've had, since 1982, you've had roughly tenfold in the Dow and probably similar in the S&P. And with a huge amount of money and with more participants all the time. And there are people coming into the market every day because they feel that they've missed the boat, or they're coming in heavier than they came in before simply because they've had a pleasant experience. And past experience does not mean much in terms of what you should expect from your investments. You will do well in your investments because you own or bought things at the right price and the businesses behaved well from that point forward.
Well, you won't have 18 more years at 17 or 18% per annum. That I think we can virtually guarantee.
Area 9.
Hello. I'm Tubby Stamen from Palm Beach, Florida. I know you enjoy bridge very much. I know you play my late husband's convention. Tell me, how often are you able to devote to this wonderful game? How many times a week do you play other than the internet?
I didn't get all of that, Charlie.
How much bridge are you playing?
Uh-oh.
Yes.
Well, we should put this in the annual report because it may be a material factor. I'm probably at least 10 hours a week, maybe a little more. I don't get any better by doing it either. It's rather discouraging, but it is a lot of fun, and it has to have come out of reading time. I don't think it's hurt Berkshire yet, but that may be because we're in a slow period generally. If the market goes down a lot, I promise to cut back on my bridge. Charlie?
Yeah. Well, I probably play 3 or 4 hours a week, but I don't play on the internet.
He plays a lot of golf, though. Confess, Charlie.
Oh, yes.
Yeah, we both spend about the same amount of time goofing off. I mean, if you want to know. Okay, Area 10.
Yes, my name is Cary Blecker, also from West Palm Beach, Florida. With all due respect to Mr. Eisner, if he's in the audience, there's been some criticism levied recently at the Disney company, mainly from an accounting professor at one of the state universities in New York, in reference to Disney's purchase of capital cities and the way they accounted for that purchase. Basically, what this professor is saying is that Disney somehow created a slush fund and is charging the expenses to the merger to this slush fund rather than earnings. If you're familiar with this criticism, I'm wondering what you think of it. If you're not, are you familiar with the way Disney accounted for the purchase of capital cities?
Yeah, I am familiar.
Thank you.
And actually, Abe Brilloff, who wrote that, is a fellow who in general I admire. Abe Brilloff, who wrote that, is a fellow who in general I admire. Abe wrote me a letter where he teaches, and I wrote him back, and I told him I wouldn't be able to do it because it's not in proximity to where I'll be. And I told him, and he asked me about the Disney thing, and I told him I disagreed with him on certain. I I admire what Abe does in the attempt to have accounting reflect economic reality, but he and I don't see it exactly the same on some points, although we would agree on other points. I don't think Disney is a very complicated enterprise to evaluate. I mean, when Cap Cities bought ABC, there were purchase accounting adjustments, and they tend to wash through to some extent. I mean, if you have programs that you're stuck on, you may write those down from what the previous carrying cost was. Maybe the previous management should have written them down too at that point. But I don't think that. I think with Disney, what you see now is what you get. Charlie?
Yeah, I've got no great quarrel with the accounting at Disney. I think Brilloff is a wonderful guy. He's got a good sense of humor, and he generally fights the right demons, but I don't think you can criticize Disney's accounting.
We certainly disagree with Abe, who, like I say, I agree with Charlie. He's a good guy, but we disagree with him on amortization of intangibles entirely. So we would say that if Disney is charging whatever it may be, probably $400 million a year for amortization of intangibles, which is not tax deductible, we would include that as a component of earnings. So there might be some pluses and minuses that you would make in adjustments, but I would say by the time you had back amortization of intangibles, that we would probably think the economic earnings of Disney might well be more than the reported earnings in the next few years. I think that the intangible amortization question, which the FASB is looking at now, I think it should be changed. I mean, I think it absolutely distorts economic reality, and I think that it influences whether people go to purchase or accounting or pooling, and they do all kinds of acrobatics to try and get pooling accounting. And it shouldn't make that kind of difference in reported numbers based on whether a transaction which has exactly the same economics is done through a purchaser pooling. But I have seen managements, some I know quite well, arrange to do things on a pooling basis that they think if they were private, they would do it on a purchase basis. And I think that's nuts. And I think if accounting is pushing people to doing things that are nuts, that it's time for accounting to look at accounting to look at itself. I would say that net the economic earnings of Disney, in our view, are somewhat higher than reported earnings. Zone 11, please.
Good morning, Mr. Munger and Mr. Buffett. My name is Prakash Puram from Minneapolis. There seem to be great values in the technology sector that meet most of your criteria, philosophy in investing, with the exception of the simplicity criterion. Names like IBM, Microsoft, HP, Intel. Would you ever consider investing in companies in this sector in the future?
Well, the answer is no, and it's probably pretty unfortunate because I've been an admirer of Andy Grove and Bill Gates, and I wish I translated an admirer of Andy Grove and Bill Gates, and I wish I translated that admiration. And I don't know what that world will look like in 10 years, and I don't want to play in a game where I think the other guys have got an advantage over me, and I could spend all my time thinking about technology. I wouldn't be the 100th or the 1,000th or the 10,000th smartest guy in the country in looking at those businesses. So that is a 7 or 8 foot bar that I can't clear. There are people that can clear it, but I can't clear it, and no matter how I train, I can't clear it. So the fact that there will be a lot of money made by somebody doesn't bother me really. And I mean, there may be a lot of money made by somebody in cocoa beans, but I don't know anything about them. And there are a whole lot of areas I don't know anything about. So, more power to them. And I think it would be a very valid criticism if Charlie and I, if it were possible that Charlie and I, and by spending a year working on it, could become well enough informed so that our judgment would be better than other people's. But that wouldn't happen, and it would be a waste of time. It's much better for us to swing at the easy pitches. Charlie?
Whatever you think you know about technology, I think I know less.
That's probably not true, incidentally. Charlie has a little more of a, he understands some things in the physical world a lot better than I do. But anyway, we'll go to zone one.
Good morning. I'm Murray Cass from Markham, Ontario. First off, against my dentist's advice, I'd like to thank you for the free Coke and ice cream last night. Earlier this morning, Mr. Buffett, you mentioned that you liked when wonderful companies like Coke purchased their shares back. Similarly, I own shares in a wonderful company, that's Berkshire. Should I be hoping that you buy your own shares back?
Well, it's interesting. We should have, perhaps we should have bought some shares back, but usually at the time we could have bought something else that also did very well for us. I mean, maybe when we were buying Coke, we could have been buying our own shares back. To some extent, there hasn't been that much trading in them, but I think it's a valid criticism to say that we have missed the boat at various times in not repurchasing shares. We'll see what we do in the future on that. If it looks like the best thing to do with money, it's what we should be doing. And in the past, I've probably been not optimistic enough in respect to Berkshire compared to other things we were doing with money. Now, the money we spent buying the Geicos and all of that has turned out to be a good use of money, too. But we've never wanted to leverage up. That's just not our game. So we've never wanted to borrow a lot of money to repurchase shares. We might advise other people to do it, but it's not our style ourselves. We've got all our money in the company. We've got all of our friends and our relatives' money virtually. So we have never felt that we wanted to leverage up this company like it was just one of a portfolio of 100 stocks. But it's a valid criticism to say that we have not repurchased shares when we should have. And it's also a valid criticism to say that we've issued some shares we shouldn't have issued. Charlie?
Well, I would agree with both comments.
Area 2.
Fellow investors of Berkshire and Hathaway, Warren Buffett and Charlie Munger. I'm from originally China. Now I have a company in Michigan. I want to ask questions based on facts. I want to sell Coke, Geico, and a little book called The Wizard of Omaha, The Investment Philosophy of Warren Buffett in China. Through all the villages, the cities, little towns, I want to make that a reality. Cheers.
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 Zone 3?
I'm not asking a question.
Oh, yeah, just warming up. Okay.
Yeah. I will.
They always tell me to get off the stage while you're in good shape, but I'll say it.
I could quit, but you missed your chance. I'm an owner of Berkshire, and I spend 6% of my net worth to be engaged to Berkshire.
Wise decision.
I did better than, guess who? Bill Gates. I noticed Bill Gates and you were traveling on a slow boat in China. I want to go home on a fast train. You want me to cut me off? If you want me to cut out, fine. Up to the investors. I quit if you want me to quit. I come a long ways. Okay. I know I'm a problem for you. But I'm here for a reason. Because I made some money. I'm going on a train. A smile train. Yesterday, or the day before at the baseball, I asked Mr. Warren Buffett, have you heard of the smile train? He said no. I'm back here to respond. This is a smile train.
Okay, we thank you, but I think that's your question. We better go to zone 4 on that. Thank you.
Good morning or afternoon, actually. My name is Matt Schwab. I'm from New York, Pound Ridge, New York. I actually had a question about the silver purchase last year. When you announced it, you said that you believed that supply and demand fundamentals would only be established at a higher price, reestablished at a higher price. I was just wondering if you could go into more detail about what some of those fundamentals are. I mean, we've read a lot about like battery technology and some other things.
Yeah, we have no inside information about great new uses for silver or anything of the sort. But the situation, and you can get these figures, and they're not precise, but I think they're in general they're generally accurate. You can see from looking at the numbers that aggregate demand, primarily from photography, from industrial uses, and from ornamental jewelry type uses, is close, call it 800 million plus ounces a year. And there are 500 million or so ounces being produced of silver annually, although there will be more coming on in the next couple of years. There's more coming on right now. However, most of that silver is produced as a byproduct in the mining of gold or copper or lead zinc, so that since it's a byproduct, it's not very responsive to price changes, because obviously if you've got a copper mine and you get a little silver out of it, you're much more interested in the price of copper than silver. So you have 500 million ounces or so of mine production, and you have 150 million ounces or so of reclaimed silver, a large part of which relates to the uses in photography. So there's been a gap in recent years of perhaps 150 million ounces, but none of these figures are precise, which has been filled by an inventory of bullion above ground, which may have been 1.2 billion or more ounces a few years back, but which has been depleted. And no one knows the exact figures on this, but there's no question that the bullion inventory has been depleted significantly, which means that the present price for silver does not produce an equilibrium between supply as measured by newly mined silver plus reclaimed silver and usage. And that eventually something will happen to change that picture. Now, it could be reduced usage, it could be increased supply, or it could be a change in price. And that imbalance is sufficiently large that even though there is some new production coming on, and there is the threat of digital imaging that will reduce silver usage perhaps in the future in photography, but we think that that gap is wide enough so that it will continue to deplete inventories, bullion inventories, to the point where a new price is needed to establish equilibrium. And because of the byproduct nature, which makes the supply inelastic, and because the nature of demand, which is relatively inelastic, that we don't think that price change would necessarily be minor. It's interesting because silver has been artificially influenced for a long time. You saw that movie about, it was William Jennings Bryan, who was editor of the Omaha World Herald and a congressman from Nebraska, and whose brother was governor of Nebraska, who was the big silver man, and they used to talk 16 to 1. The 16 to 1 ratio, I think, goes back to Isaac Newton when he was master of the mint. Charlie will know all about that because he's our Newtonian expert here. But that ratio had kind of mystical significance for a while. It didn't really mean anything. And in 1934, the government passed an act called the Silver Purchase Act of, surprisingly, 1934, which set an artificially high price for silver at that time, when production and usage was much less. And the U.S. government ended up accumulating 2 billion ounces of silver. Now, this was at a time when demand was a couple 100 million ounces a year, so you're talking 10 years supply. So there was an artificially high price for a while. By the early 1960s, that became an artificially low price of $1.29. And at that time, I could see the inventories of the U.S. government being depleted, somewhat akin to what inventories are being depleted now. And despite the fact that Lyndon Johnson and the administration said they would not demonetize silver, they did demonetize it, and silver went up substantially. That was the last purchase we had of silver, but I've kept track of the figures ever since. The Hunt brothers caused a great amount of silver to be converted into bullion form, including a lot of silver coins. So they again increased the supply in a very big way by their action and pushing the price way up to the point where people started melting it down. So you had these dislocations in silver over a 60-plus year period, which has caused the price to be affected by these huge inventory accumulations and reductions. And we think right now that, or we thought last summer when we started buying it, that at the price we bought it, that was not an equilibrium price, and that sooner or later, and we didn't think it was imminent because we don't wait till things are imminent. We were going to buy a lot of silver. We didn't want to buy so much as to really disrupt the market, however. We had no intention of replaying any Hunt scenario, so we wanted to be sure we didn't buy that much silver, but we liked it. Charlie?
Well, I think this whole episode will have about as much impact on Berkshire Hathaway's future as Warren's bridge playing. We've got a line of activity where once every 30 or 40 years you can do something employing 2% of assets. This is not a big deal for Berkshire. The fact that it keeps Warren amused and
yeah, I did like
not doing counterproductive things.
It makes me feel better about all those pictures that people take over the weekend. They all use a little bit of silver.
At least it shows something that teaches an interesting lesson. Think of the discipline it takes to think about something for 3 or 4 decades, waiting for a chance to employ 2% of your assets. I'm afraid that's the way we are. It means there'll be some dull stretches.
Right. Yeah, it's less than $1 billion in silver. It's $15 billion in coke. It's
a non-event.
It's $5 billion in American Express. I mean, it is close to a non-event, but if you see it there,
at least it shows the human personality at work. Very peculiar personality, I might add.
Reinforced by a partner.
Yes.
Okay, let's go to Area 5.
My family is a Class B shareholder. Thank you for issuing those shares. I have one observation and one question. Your Class B share is creating a new phenomena in this country. These baby shares are not only attracting my baby boomer generation, but also X generation and eco generation, your grandchildren. My question is, this next generation would like to hear from you, your investment discipline, your lifestyle, and your philosophy of contributing the wealth back to the society in a language they can understand and communicate back to their friends when they get back to school on Tuesday. Thank you.
Thank you. Well, I appreciate that, and I would say the only speeches I give, I get a lot of requests, perhaps because I don't do them, but I get a lot of requests, including from a lot of our managers in terms of trade conventions, all kinds of things. The only groups I talk to are students, and I try to talk to college and university students, although I've talked to high school students too, whenever it fits in terms of travel schedules, and I just think that if you're going to spend your time with groups talking, that rather than entertain people, that it probably is better to talk to the group who talked about it. And Charlie and I are never reluctant to talk, so we do it. Charlie has given a couple of talks. One I sent you a few years ago from USC, but there's been another one recently that I think everybody would profit by by reading, so it was reprinted in the Outstanding Investor Digest, but if you write Charlie, I'm sure he'll send you a copy. Area 6, please.
Hi, my name is David Osterbahn. I'm from Kalamazoo, Michigan. This is a hypothetical question about Berkshire. It's going to take a little imagination, I think. The scenario as follows: that the U.S. Justice Department makes a ruling that Berkshire must split into two parts immediately. You and Mr. Munger must decide which part to keep. You can either choose your marketable securities, Coke, Gillette, Disney, etc., or you can choose your insurance and private businesses. Which one do you choose and why?
Well, that's an easy question for me. I would choose the operating businesses anytime because it's more fun. And I have a good time out of the investments too, but I like being involved with real people in terms of the businesses where they're a cohesive unit that can grow over time. And I wish we owned all of Disney or Coca-Cola or Gillette, but we aren't going to. So if I had to give up one or the other, I'd give up the marketable securities. But it's not going to happen. So we're going to be happy in both arenas, and I look forward to being in both arenas for the rest of my life. Charlie?
Well, I'll be in a hell of a fix if I'm not in the same arena.
We'd both be in a hell of a fix.
Yeah.
Area 7.
Yes, hello to Mr. Munger and Mr. Buffett. My name is Jerry Gonzalez from Plantation. My question is, what are your recommendations of Berkshire Hathaway if Charlie Munger were in charge, or your third man in charge, your third man, which I think you said, it's the CEO of Geico. What are your recommendations? If Charlie Munger were to be in charge fully, 100%, or your third man, the CEO of Geico.
Well, in due course, this corporation will have a change in management. I'm afraid we have no way of fixing that. But we do not, apart from making sure we've got good options and having some system in place, we are not obsessing about a future management yet.
No, well, the director
Warren plans to live almost indefinitely.
Absolutely. Although I must say, at my last birthday, somebody asked me how old I was. I said, "Well, why don't you just count the candles on the cake?" And he said he was driven back by the heat. So, but we're not going to leave willingly. And the directors know who, and they have a letter that says who they think, who we think should be the ones to succeed us at both the operating aspect and the investment allocation aspect, and that those letters can change over time as we keep hanging around. But I don't worry about the fact that 99% plus of my estate will be in Berkshire Hathaway stock, or that a foundation will eventually receive that stock. So it doesn't bother me in the least. I can't think of a place I'd rather have it. And that includes my appraisal of the managers that we have who can step in and do what Charlie and I do, and who knows, one of them may even understand technology.
I think this place would have very respectable prospects if the top 25 managers all drop dead at once.
Well, that's not an experiment we intend to pursue.
No, but I see no reason to think it wouldn't continue to do quite well.
Right.
It's been lovingly put together to have a certain margin of safety.
We actually, if we have a choice, it's number 3 through 23, though, that we're 25 that we're interested. Okay, area 8, please.
This is Raul from Walnut Creek, California. Thanks, Mr. Buffett. Thanks, Mr. Munger. Thanks for your great company. wish I had known about it 10 years ago. You are not only the greatest, but the most honest. I want to commit 99% of what I have to Berkshire Hathaway, and I will. The question I want to ask is, how do you calculate the intrinsic value of the company? And based on intrinsic value, to me, Berkshire Hathaway looks a great bargain at these prices, especially based on look-through earnings. Is that true? And one last question I want to ask, just for fun. What do you think about telecom IPOs like Quest, USLEC? They seem to pop up 50% at opening. Does it make any sense to invest in these? Thank you very much.
Charlie, you want to tackle that?
I didn't follow that all. Intrinsic value, we give you the facts and you make your own conclusions. I like the fact that you think we're honest, but you know, if you people keep bidding up the price of our stock, honesty will only do so much for you in the future.
Yeah, we've never been tested. I mean, we're very lucky. We've never had, we've never had anything that we needed really that we haven't had. And who knows what the situation would be if your family was starving or something. So our intention is to continue in a position where we'll never be tested too, I might add. The intrinsic value question, I mean, by definition, intrinsic value is the present value of the stream of cash that's going to be generated by any financial asset between now and doomsday. And that's easy to say and impossible to figure, but it's the kind of thing that we're looking at when we look at a Coca-Cola, where we think it's much easier to evaluate the stream of cash that comes in the future than it is in a company such as Intel, marvelous as it may be. It's easier for us. It may not. Andy Grove may be better at figuring out Intel than Coke. And in Berkshire, it is complicated by the fact that we have no business that naturally employs all of the capital that flows to us. So it is dependent to some extent on the opportunities available and the ingenuity used in when that cash pours in, as it does. Some businesses have a natural use for the cash. Actually, Intel has a good natural use for the cash over time as they've expanded in their business, and many businesses do. But we do not have a natural use. We have some businesses that use significant amounts of cash. Flight Safety will buy a lot of, build a lot of simulators this year, and they cost real money. But in relation to the resources available, we have to come up with new uses, new ways to use cash, and that makes for a more difficult valuation job than if you've got, well, the classic case used to be a water or electric utility where the cash could be deployed and the return was more or less guaranteed within a narrow range. And it was very easy to make calculations then as to the expectable returns in the future. But that's not the case at Berkshire. We've got very good businesses, and both directly and partially owned, and those businesses are going to do well for a long, long time. But we do have new cash coming in all the time, and sometimes we have good ideas for that cash, and sometimes we don't, and that does make your job more difficult in terms of computing intrinsic value. We'll have, we're going to break after the next question. At that time, we break whenever Charlie and I run out of candy up here, actually. We're going to let everybody that you can get something to eat if you want to stick around, and we will be here till 3:30 when we reconvene at 12:30. And those of you who have been with us this morning and have had enough, we thank you for being here this weekend. We've had a terrific time with you, so I'm very appreciative of that. Let's have a question from Zone 9, and then we'll go to lunch.
Good morning. My name is Frank Jervich. I'm a shareholder from London, Ontario, Canada. My question is for Mr. Munger, and it concerns his models. And the question specifically is related to market valuation. I know I'm not going to get a prediction. That's not your bag. What I'm curious about is there any specific touchstone models that you reflect upon and trying to gain perspective at these markets where the historic valuations are quite high, and why do you draw on those models? My second question is for Mr. Buffett, and it relates to taxation. If you were able to trade your portion of your portfolio at least in a tax-exempt fashion, like 401k plans or in Canada the RSP plans, would you possibly trade more actively?
Charlie, you want to answer yours first?
Yeah. Well, the Munger system for dealing with reality is to have multiple models in the head and then run reality against multiple models. I think it's a perfect disaster to look at reality through just one model or two. There's an old proverb that says, to the man with only a hammer, every problem looks pretty much like a nail. And that is not our system. So I can't sit here and run through all the models in my head, even though there aren't that many. But multiple models is the game.
The question about taxation, it would not, if we were running Berkshire absent a capital gains tax, I don't think it would make much difference in what we do. I don't think it would make, it certainly wouldn't make a difference in causing us to trade actively. We own the businesses we want to own. We don't own them because taxes have restrained us from selling them. And as I mentioned earlier, I'm fairly sure we'll pay at least $1 billion in income tax this year. We might not, but it looks that way to me, that we'll pay $1 billion. And I could do things that at least deferred, and I certainly could do things by doing nothing that avoided paying that $1 billion in tax, or a good bit of the $1 billion, call it $800 million of the $1 billion. But that is not a big factor with me. It's never been a big deal with me. I paid my first income tax when I was 13, so I guess I got brainwashed at the time. And it doesn't bother me a lot to be paying taxes. I think net personally, I'm undertaxed in relation to what the society has delivered to me. And I don't send along any voluntary payments to the IRS. I want you to understand. But I really do. I mean, there's nobody I want to trade places with, and because their tax situation is better than mine, and so it would not increase the activity. I've been asked to take one more question from Zone 10. I'm not sure why, but maybe because they see that I still have candy up here. So Zone 10, please, and then we'll break.
Mr. Buffett and Mr. Munger, my name is Sanjeev Merchandani, shareholder from Boston. First of all, thank you to both of you for everything. I have two questions. For you, Mr. Buffett, you obviously have filters that you apply on selecting people as you do on stocks. Can you tell us a little bit about what those filters are?
Filters on people?
Yes, in selecting, you have an ability to motivate people who have a lot of money to keep working. What do you look for to figure out who those people are?
Well, that is a key question, because when we buy businesses, we don't have managers to put in them. I mean, we're not buying them that way. We don't have a lot of MBAs around the office that we're...
Thank God.
Yeah. That I have not promised that they're going to have all kinds of opportunities. So, as a practical matter, we need management with the businesses that we buy. And 3 times out of 4 or thereabouts, the manager is the owner and is receiving tens of millions, maybe hundreds of millions of dollars. So they don't have to work. And we have to decide in that time when we meet them whether they love the business or love money. And we're not making a moral judgment. Charlie may, but I'm not making a moral judgment about whether it's better to love the business or love money, but it's very important for me to know which of the two is the primary motivator with them. And we have had extremely good luck in identifying people who love their business. And so all we have to do is avoid anything that on our part that diminishes that love of the business or makes other conditions so intolerable that they overcome that love of the business. And we have a number of people working for us that have no financial need to work at all. And they probably outwork, 95% or more of the people in the world, and they do it because they love smacking the ball. And we virtually had no mistakes in that respect. And we have identified a number of people, Charlie and I have, in terms of proposals to us, where we felt that they liked the money better than the business. They were kind of tired of the business, and they might promise us that they would continue on and they would do it in good faith, but something would happen 6 months later or a year later, and they'd say to themselves, why am I doing this, for Berkshire Hathaway when I could be doing whatever else they want to do? I can't tell you exactly what filter it is that we put them through mentally, but I can tell you that if you've been around a while, I think you can have a pretty high batting average in coming to those conclusions, as you can about other aspects of human behavior. I'm not saying you can take 100 people and take a look at them and analyze their personalities or anything of the sort, but I think when you see the extreme cases, the ones that are going to cause you nothing but trouble or the ones that are going to bring you nothing but joy, I think you can identify those pretty well. Charlie?
Well, yeah, I think it's pretty simple. You've got integrity, intelligence and experience and dedication. And that's what human enterprises need to run well. And we've been very lucky in getting this marvelous group of associates to work with all these years. It would be hard to do better, I think, than we've done in that respect. Look around this place. I mean, and particularly you young people, look around this place. Look at how much gratification can come into these lives, which have been mostly spent in deferring gratification. It's a very funny group of people, you shareholders.
Well, on that note of self-congratulation, let's go have lunch, and we'll be back in half an hour. Let's settle down, please, and we're going to go to, we skipped one last time, so we're going to go first to Zone 4.
Hello. My name is Nelson Arata. I'm from Southern California, and I have a question. It's not really related to intrinsic value or any of that stock stuff, but more on houses. I'm still quite young. I don't have a house yet, and I'm thinking about buying a house someday soon. And in order to do that, I'm going to have to put a down payment, which means I might have to share or sell my shares. And I was wondering if you can provide some insight on when is the best time to buy a house and how much down payment you should be putting down in relation to interest rates and also in relation to available cash and the stock market.
Well, Charlie's going to give you an answer to that in a second. I'll just relate one story, which was when I got married. We did have about $10,000 starting off, and I told Susie, I said, now, you know, there's two choices. It's up to you. We can either buy a house, which will use up all my capital and clean me out, and it'll be like a carpenter who's had his tools taken away from him, or you can let me work on this, and someday, who knows, maybe I'll even buy a little bit larger house than would otherwise be the case. So she was very understanding on that point, and we waited until 1956. We got married in 1952, and I decided to buy a house when the down payment was about 10% or so of my net worth, because I really felt I wanted to use the capital for other purposes. But that was a way different environment in terms of what was available to buy. In effect, if you have the house you want to buy, I definitely believe in just going out and probably getting the job done. But in effect, you're probably making something in the area of a 7 or 8% investment implicitly when you do it. So, you'll have to figure out your own equation from that. Charlie probably has better advice on that. He's a big homeowner in both senses of the word.
I think the time to buy a house is when you need one.
And when do you need one?
Well, I have very old-fashioned ideas on that too. The single people, I don't care if they ever get a house.
When do you need one if you're married, Charlie? I'll follow up here for this. You need one when your wife wants one.
Yeah. I think you've got that exactly right.
Yeah. Sure.
Gregory Crawford needs to go to the security office, please, for emergency message. Gregory Crawford to the security office for emergency message. Thank you.
Okay. Hope it isn't a margin call. Okay, we'll go to zone 1, please.
I'm Ralph Pfeffer from Phoenix, Arizona. The question I'm going to ask does not pertain to Berkshire Hathaway. But I would appreciate it if you gentlemen, if you can, explain the justification and rationalization for the exorbitant salaries, bonuses, perks, directors' fees, and other benefits that most public corporations are paying.
Well, I would say this. In my own view, the most exorbitant are not necessarily the biggest numbers. What really bothers me is when companies pay a lot of money for mediocrity, and that happens all too often. But we have no quarrel in our subsidiaries, for example, for paying a lot of money for outstanding performance. I mean, we get it back 10 or 20 or 50 for one. And similarly in public companies, we think that there have been managers and are managers who have taken companies to many, many, many billions of market value, more than would have happened with virtually anyone else. And they sometimes take a lot of money for that. Sometimes, as in the case of Tom Murphy at Cap Cities, it just didn't make a difference to him. I mean, he performed in a way that would have justified huge sums, but it wasn't. I mean, he would tell you that he had all the money he needed, and he just didn't care to take what the market might bear. But I am bothered by irrational pay systems And I'm particularly bothered when average managers take really large sums. I'm bothered when they design or have designed for them systems that are very costly to the company, maybe partly to make themselves look good because they want huge options themselves, so they feel like they give options widely throughout the company. So they design a system that is illogical company-wide because they want one that's illogical for them personally. But large sums per se don't bother me. I'm not saying, whether any individual might want to take them or not. But I do not mind paying a lot of money for performance. It's done in athletics, it's done in entertainment, but in business, the people who are the 200 hitters and the people who would not attract a crowd as an entertainer have worked it out so that, the system has evolved in such a way that many of them take huge sums, and I think that's obscene, but I can tell you there isn't much you can do about it. The system feeds on itself, and companies do look at other companies' proxy statements. Every CEO does, and they say, well, if Joe Smith is worth X, I have to be worth more. And they tell the directors that certainly you wouldn't be hiring anybody that was below average, so how can you pay me below average? And the consultants come in and ratchet up the rewards, and it's not anything that's going to go away. It's like we were talking about campaign finance reform earlier. The people who have their hands on the switch are the beneficiaries of the system. Who have their hands on the switch are the beneficiaries of the system, benefiting enormously and perhaps disproportionately from that system. Charlie?
Well, yeah, I'd like to report that the original Vanderbilt behaved even better than the people at Berkshire Hathaway. He didn't take any salary at all. He thought it was beneath him as a significant shareholder to take a salary. That ideal, I'm afraid, died with him.
Yeah, Charlie and I, our directors are paid $900 a year, but I tell them on an hourly basis they're making a fortune because we don't work them that hard. But what Charlie and I did not think through when we established that $900 a year is that they set our salaries too. So we have not followed the standard procedure, which is to load it on the directors, and the directors shall load it on you.
I do think it will have pernicious effects for the country.
Load it on you.
I do think it will have pernicious effects for the country. It's escalating because I think you're getting at the very top, corporate salaries in America are too high. And that is not a good thing for a civilization when the leaders are regarded as not dealing fairly with the institutions that they head. All I can say is that prostitution would be a step up for them.
Put him down as undecided. Zone 2, please.
I'm Dan Blum from Seattle, Washington, via Cambridge, Massachusetts. I want to ask whether the issuance of Class B stock has achieved the objective which you announced for it when it was created.
Well, I would say this, that considering the alternatives we faced, which was the imminence of unit trusts that would have been promoted with heavy front-end commissions, with substantial annual fees, with bad tax consequences, and with probably a misrepresentation of the historical record in such a way that people who really didn't know much about securities would have been enticed in. With that as an alternative, I think the B stock was the best thing we could have done, and I feel good about how it's worked out. I think that we didn't set out to issue it. We don't like talking anybody into buying our stock, but I don't think in any way that the group we have here diminished in the least by having a mix of B and A shareholders as opposed to A only. The B has worked out as well as possible. I hope that we haven't enticed anybody in with unreasonable expectations. That's the biggest thing that Charlie and I worry about. And it's hard not to have that happen with the historical record. I know it would have happened in a big way with the unit trust. So, it's like making the mistake originally of starting with Berkshire. I think we enjoy things as they come along, and we've gotten a good group with the B shareholders, and we're happy with the present situation. Charlie?
Yeah, we wanted to step hard on what we regarded as a disreputable financial scheme, and that we did.
And I think the way we sold the B was such as to attract the kind of people who really did look at it on a long-term basis. We did everything we could to discourage people who thought they were going to make a lot of money in a hurry. So I think we attracted a whole new group of shareholders who were quite similar in perspective to the shareholder group that we already had, and that was our hope. Zone 3, please.
My name is Alan Rank from Pittsburgh. I first want to thank Susan Jacques for returning the cocktail yesterday, and I hope she was rewarded with good sales at Borsheim's. Question is regarding the fact that you don't report details of anything under $750 million, and with the change of the values of small cap in relation to large cap, would that be something that Berkshire or individuals might try to look as opportunity with the small cap premium shrinking as it has?
We don't worry about whether a stock is small cap or large cap, except to the extent that by now we've gotten to a point where anything below a certain level just is not of interest to us because it can't be material to our results. So we never think of opportunities as existing because of something as small cap or sectors or all that, what generally gets merchandised. So our cutoff point is set more or less at the point where we think it's material. That's not as defined by the SEC. We could have a higher limit, but we think when you get down below 2% of assets or thereabouts, that the reporting of positions would not affect anybody's calculation of intrinsic value or give them insights about the way we run the business, but it would be more for the people who are looking for things to piggyback on. And so we will move the cutoff point up as we go along. Because of our size, we will never be in companies that have capitalizations that of $500 million or $1 billion, because we just can't put enough money in. Occasionally we'll be in one just by accident, but we're looking at things that we can put $500 million in ourselves at least. At $500 million, a 5% position is a $10 billion market cap, and that limitation has hurt, will hurt, is hurting our performance to some degree. If Berkshire were exactly 1/100th of its present size, in all respects owning the operating businesses it did, but all 1/100th the size, our prospects would be better than they are with the kind of money we have presently. Charlie?
I've got nothing to add.
Okay, Zone 4, please.
Okay. My name is Tom Conrad. I'm from McLean, Virginia. I just wanted to first thank you, Mr. Buffett and Mr. Munger, for each year answering our questions. I found myself at 5 a.m. standing outside the door here, and I don't do that for anyone. And it's a real pleasure to hear your answers. I have two questions. One is, with Travelers, the company Travelers, and their merger with Citibank, do you have confidence in the management of Sandy Weil? My second question is, you said it in a few meetings ago that diversification is a protection against ignorance. And it only takes 3 great companies to be set for an investment lifetime. And I invested in those 3 companies, Coca-Cola, Gillette, and Disney. And I went ahead and invested in a 4th company without asking you. I invested in Pfizer, and I just wonder what you think about the pharmaceutical industry, if you feel there's some great companies in that industry. Thank you very much.
Yeah, well, we think Sandy Weil is a very, very good manager. Sandy is, the record is clear. It is not easy to manage in Wall Street. And Sandy has done an excellent job there, as well as in other allied or somewhat allied fields. So his record is proven. And he has done the last, ever since buying commercial credit from Control Data, he's built a terrific company. And he's built a terrific company in businesses that themselves aren't necessarily so terrific. So it's required real management skill. Pharmaceuticals, we missed. We would not have known how to pick out any single business, single company within the industry. But we certainly should have didn't do anything about it, that the industry as a whole represented a group that would achieve good returns on equity, and where some sort of a group purchase might have made sense. We did buy one a while back, but we didn't. It was peanuts, and it would have been. It was within our circle of competence to identify the industry as likely to enjoy very high profits over time. It would not have been within our circle of competence to try and pick a single company. Charlie?
Yeah, we stupidly blew that one.
We'll blow more, too. Zone 5.
Yes, sir. Good afternoon. My name is Matt Lovejoy from Lexington, Kentucky. And gladly, I'm not a consultant. I have a question, sir, Mr. Buffett, about your operating management style. In my opinion, the mainstream media minimizes the significance of your non-public operating investments. When you consider capital allocation in these companies, do you have the managers submit annual business plans? And if so, do you formally meet with those managers to see how well you can track progress against those plans?
Yeah, that's a good question, and the answer is that we may meet with some of them annually, we may meet with others semi-annually, but we have no formal system whatsoever, and we will never have a formal system. We don't demand any meetings of any of our managers. We have no operating plan submitted to headquarters. Some of the companies use operating plans themselves, some of them don't. They are all run by people who have terrific records, and they have different batting styles. And we're not about to tinker with somebody that's batting with 375 just because somebody else holds the bat a little differently or uses a different weight bat or something of the sort. So we believe in letting them do currently and in the future what has been successful for them in the past. And different people have very different styles. I've got my own style, but we have managers that like to talk things over. We have other managers that like to go their own way. And we have managers that have a by-the-book approach, which works well. We have other managers that wouldn't dream of that. We have managers that, most managers probably have monthly statements of financials. We have other managers that don't. And that really isn't a problem. What we want to have is good managers. And there's more than one way to get to at least business heaven. And we have a number that have found different ways to get there. So we have never imposed. We have certain requirements because we're a public company, and SEC requirements and Internal Revenue Service coordination. But we have never imposed anything from the top on any of the operating managements. We have MBAs running companies. We have people that never saw a business school. And talent is the scarce commodity. And when you find talent and they've got their own way of doing things, we're delighted to have them do it. More than letting them have them do it. We want them to do it their way. We don't want to change them. Charlie?
Yeah, the truth of the matter is that we have decentralized power in the operating businesses to a point just short of total abdication. And we don't think our system is right for everybody. It has suited us and the kind of people that have joined us. But we don't have criticism for other people like Emerson Electric or something who have operating plans and compare performance quarterly against plan and all that sort of thing. It's just not our style.
Yeah, we centralize money, and everything else we decentralize pretty much. But I don't know whether you've met him here, but for example, Al Yolshi is here. He started flight safety in 1951, and I don't know what he'll spend on simulators this year, but it could easily be $100 million or thereabouts. And if I spent hours with him, I couldn't add 1/100th of 1% to his knowledge of how to allocate that money. I mean, it would be ridiculous. It'd be a waste of his time, and it would be an act of arrogance on my part. And I have no worries about how Al allocates the money. And that's an unusually capital-intensive business compared to most of our businesses. There's some that I get into the details more because I've just worked with a person that's running things a long time, and we kind of enjoy it. Ajit and I talk virtually every night about the reinsurance business. I am not improving the quality of his decisions at all, but it's an interesting game, and I like hearing about it, and he doesn't mind talking about it, so we talk them over. But that's just a matter of personal chemistry. And as we add managers, we will adapt to them. We adapt our accounting systems to a degree to them. Now we do have certain requirements that result from the SEC and IRS, but we don't. Our managers know their businesses, and they know how to run them. And if they don't, this hasn't been the case, but if they didn't, we would, we'd do something about the manager. We wouldn't try and build a bunch of systems. Zone 6, please.
Good afternoon, gentlemen. My name is George Donner from Fort Wayne, Indiana. My question has to do with estimating the intrinsic value of a company, in particular the capital-intensive companies like you were mentioning. I'm thinking of things like McDonald's and Walgreens, but there are lots of others where you have a very healthy and growing operating cash flow, but it's largely or completely offset by heavy expenditures on putting up new stores or restaurants or building a new plant. And so my question is, what do you do for your estimate of future free cash flow? And with treasuries around, long treasuries around 6%, at what rate do you discount those cash flows?
Well, we discount at the long rate just to have a standard of measurement across all businesses. But we would take the company that is spending the money as it comes in, and they don't get credit for gross cash flow. They get credit for whatever net cash is left every year. But of course, if they're spending the money wisely, even though you have to discount it for more years, the growth in cash development should offset that, or they weren't investing it wisely. The best business is one that gives you more and more money every year without putting up anything to get it, or very little. And we've got some businesses like that. The second best business is a business that also gives you more and more money. It takes more money, but the rate at which you reinvest the money to get that growth is a very satisfactory rate. The worst business of all is the one that grows a lot, and where you're forced in effect to grow to stay in the game at all, and where you're reinvesting the capital at a very low rate of return. Sometimes people are in those businesses without knowing about it. But in terms of discounting, in terms of calculating intrinsic value, you look at the cash that is expected to be generated, and you discount back. In our case, we use the long-term treasury rate. That doesn't mean that you pay the amount that present value calculation leads to, but it means that you use that as a common yardstick, that treasury rate. And That means if somebody is reinvesting all their cash flow the next 5 years, they better have some very big figures coming in down the road, because at some day a financial asset has to give you back cash to justify you laying out cash for it now. Investing is the art, essentially, of laying out cash now to get a whole lot more cash later on, and something at some point better deliver cash. Ben Graham in his class we used to talk about what he called the Frozen Corporation. And the Frozen Corporation was a company whose charter prohibited it from ever paying anything to its owners, or ever being liquidated, or ever being sold. And
sort of like a Hollywood producer.
yeah. And the question was, what was such an enterprise worth? Well, that's sort of a theoretical question, but it forced you to think about the realities of what business is all about. And business is all about putting out money today to get back more money later on. Charlie?
I do think there is an interesting problem that you raise, because I think there is a class of businesses where the eventual cash back part of the equation tends to be an illusion. I think there are businesses where you just keep pouring it in and pouring it in, and then all of a sudden it doesn't work and no cash comes back. And what makes our life interesting is trying to avoid those and get on the alternative kind that drowns you in cash.
The one figure we regard as utter nonsense is the so-called EBITDA. I mean, the idea of looking at a figure before the cash requirements of merely staying in the same place, and there usually are. Any business with significant fixed assets almost always has with it a concomitant requirement that major cash be reinvested in order simply to stay in the same place competitively and in terms of unit sales. To look at some figure that is before that is stated before those cash requirements is absolute folly, and it's been misused by lots of people to sell lots of merchandise in recent years.
It's not to the credit of the investment banking fraternity that it has learned to speak in terms of EBITDA. I mean, the idea of using a measure that you know is nonsense and then piling additional reasoning on that false assumption, it's not creditable intellectual performance. And then once everybody is talking in terms of nonsense, why, it gets to be standard.
Zone 7, please.
Hi, my name is Brandon Vecchio, and I'm in the Academy of Finance at Northwest High School here in Omaha. Could you explain the criteria you look at when selecting your stocks?
Well, we look at, and I'm glad you came. I hope there's a large group. I got a note, I think, from your teacher on that. We look at it, the criteria for selecting a stock is really the criteria for looking at a business. We are looking for a business we can understand. That means they sell a product that we think we understand, and we understand the nature of their competition, what could go wrong with it over time. And then when we find that business, we try to figure out whether the economics of it means the earning power over the next 5 or 10 or 15 years is likely to be good and getting better, or poor and getting worse. But we try to evaluate that future stream. And then we try to decide whether we're getting in with some people that we feel comfortable being in with. And then we try to decide what's an appropriate price for what we've seen up to that point. And as I said last year, what we do is simple but not necessarily easy. The checklist that is going through our mind is not very complicated. Knowing what you don't know is important, and sometimes that's not easy. And knowing the future is definitely, it's impossible in many cases in our view, and it's difficult in others, and sometimes it's relatively easy, and we're looking for the ones that are relatively easy. And then when you get all through, you have to find it at a price that's interesting to you, and that's very difficult for us now, although there have been periods in the past where it's been a total cinch. And that's what goes through our mind. If you were thinking of buying a service station or a dry cleaning establishment or a convenience store in Omaha, to invest your life savings in and run as a business, you think about the same sort of things. You think about the competitive position and what it would look like 5 or 10 years from now and how you were going to run it, who was going to run it for you, and how much you had to pay. And that's exactly what we think of as when we look at a stock, because a stock is nothing other than a piece of a business. Charlie?
Yeah, if finance were, when finance is properly taught, it should be taught from cases where the investment decision is easy. And the one I always cite is the early history of National Cash Register Company. And that was created by a fanatic who bought all the patents and had the best sales force and the best production plants. And he was a force in the best production plants. And he was a very intelligent, was a godsend to retailing when cash registers were invented. So that was the pharmaceuticals of a former age. If you read an early annual report prepared by Patterson, who was CEO of National Cash Register, an idiot could see that this was a talented fanatic, very favorably located, and that therefore the investment decision was easy. If I were teaching finance, I would collect 100 cases like that, and that's the way I would teach the students.
We have that annual report. What was that, 1904 or something, Charlie? But it's really a classic report, because Patterson not only tells you why his cash register is worth about 20 times what he's selling it for to people, but he also tells you that you're an idiot if you want. But he also tells you that you're an idiot if you want to go in competition with him. It's a classic.
It is just a total report and not realize that this guy can't lose.
Area 8, please.
Good afternoon. My name is Robert Rowland from London, England. I've been in Omaha all weekend with my wife on the first leg of my honeymoon, and I've noticed you're quite a buyer of nostalgic assets. Can I ask whether nostalgia is one of your filters? Are there any assets like that left in the US to buy? And if not, can I suggest you come to the UK, where all we do is sell them?
Well, I don't want to interrupt your honeymoon, but if you'd send me a list of those companies over there that are long on nostalgia, that might be to our liking, because Charlie and I tend to operate from sort of a Norman Rockwell frame of mind, and it is true that the kind of companies we like sort of do have a homey Norman Rockwell Saturday Evening Post type character to them. They have character. And they're the kind of companies, I think, frequently that people, when they join them, expect to spend the rest of their lives there, rather than look at it as something to stick on the resume. And there are businesses like that. If you look at the businesses that we've bought in the last 3 or 4 years, there is real character to the businesses and to the people that build them, and that's why the people that build them stay on and feel very strongly about running them correctly, even though they can have no financial consequence to themselves whatsoever. So even though they can have no financial consequence to themselves whatsoever. So after your honeymoon, drop me a line. Zone 9, please.
Good afternoon. Joshua Andrews from Omaha Northwest High School, Academy of Finance.
Good.
And on behalf of the Academy of Finance, we want to thank you for the tickets. There's 33 of us in attendance today.
Terrific.
We had the opportunity to play a national game, an investment challenge, and on the list of stocks there were Berk A and Berk B. Can you explain what the difference of the two stocks are?
Yeah, the difference between the Berkshire A and B is simply that an A can be converted to a B at any time in the ratio of 1A into 30 Bs. The B cannot be converted into the A, so it's a one-way street into 30 Bs. The B cannot be converted into the A, so it's a one-way street on of the B is exact. So anything that anytime the A ever gets any money of any kind, from dividends or liquidation or a merger or something of the sort, for every $30 that you get on the A, you're going to get $1 on the B. The two differences are that there is less voting power proportionately in the B, and the B does not participate in a designated contributions program that Berkshire runs, simply because that would be very, very hard to administer. And when we issued the B, we pointed out those two differences. The B should never sell for more than 1/30th of the price of the A. When it sells just a tiny bit above that, then arbitrage settles in as people buy the A and convert it to B and sell the B. Occasionally the B may be at a slight discount to the A because it's not convertible the other way. But I think as a practical matter, you can treat the A and B as very equivalent investment choices. There's A and B as very equivalent investment choices. There's area 10, please.
My name is Sheena Sho from the Academy of Finance. What recommendations would you give us as teenagers to prepare for our future and become as successful as you?
Well, if you're interested in business, I definitely think you ought to learn all the accounting you can by the time you're in your early 20s. Accounting is the language of business. Now, that doesn't mean it's a perfect language, so you have to know the limitations of that language as well as all aspects of it. So I would advise you to learn accounting, and I would advise you to be, in terms of part-time employment or anything else, work at a number of businesses. There's nothing like seeing how business operates to build your judgment in the future about businesses. When you understand what kind of things are very competitive and what kind of things are less competitive and why that works that way, all of that adds to your knowledge. So I would do a lot of reading. If you're interested in investments, I would take the accounting courses. I do a lot of reading about investments, and I would get as much business experience. I would talk business with people that are in business to find out what they think makes their operation tick or where they have problems and why. I just think you just kind of sop it up every place that you can, and if it turns you on, you'll do well in it. I mean, I think that if it there certain activities grab different people, but if business is of interest to you, my guess is you'll do well. And if you understand business, you understand investments. Investments are simply business decisions that in terms of capital. Investments are simply business decisions that in terms of capital.
Yeah, there's also the little matter of underspending.
Mastered.
Yes. That really works if you keep at it.
Yeah, I mean, Charlie and I both. Charlie started having children at a rapid rate, so he was a lawyer when there was not big money, and then, but I was any money you save before you get out and start having a family is probably worth any dollar is probably worth $10 later on, simply because you can save it. It's the time to save is young, and you'll never have a better time to save than really pre-formation of a family, because the expenditures come along then, whether you like them or not. So work for yourself first and put the money aside. I was lucky that way. I didn't have to pay for my own college. Probably wouldn't have gone to college if I'd had to pay for it. But I was able to save everything I made in my teens, and those dollars got magnified quite a bit. Whereas the money when I started first selling securities, I mean the money I made then was taken up by family needs to quite an extent. So start saving early. A lot of it's habit anyway, so it's a great habit to have. Okay, zone 1, please.
I'm Tony Alsnett from New York City. Following up on the questionnaire from London, in light of the current dearth of investment opportunities, do you see yourselves investing in non-U.S. companies which are well-managed, understandable, and growing?
Well, if we find such companies as you describe at a price that's half attractive, we're perfectly willing to buy them. So the answer to that is yes, but we would be looking to an extent worldwide, irrespective of market conditions in the United States. Now, market valuations in this country tend to be fairly well matched in most of the major countries. So there's been a bull market all over the world in a huge way in the bigger markets. And so unfortunately, I mean, it would have been nice for us if the U.S. market had tripled and other markets had stayed the same, and then we would be very likely to be finding things abroad. We're not finding them abroad, but we're certainly looking for the kind of thing you're talking about. We are not reluctant to invest abroad, and our all three of our largest holdings, American Express, Gillette, and Coke, and we're talking about $25 billion of market value there that we have. All three of those have major businesses abroad, and in the case of Coke and Gillette, it's a majority of their earnings from abroad. So we're interested, and there's better growth opportunities in many areas abroad than here. Finding bargains as we look around the world. Charlie?
Nothing more.
Okay. Area 2.
My name is Henry Allen, Mamaroneck, New York. Question I have is a little delicate, relates to my family and heirs rather than myself, because I'm a couple of decades older than you gentlemen. You've been very candid about the succession and the estate planning, but how will the recipients of huge grants, charitable grants, get the liquidity they need to use the money without unduly driving the stock down?
Well, I don't think that supply and demand in terms of specific, let's just say that 3% of Berkshire were to be added to the supply annually. I don't think that makes much difference. What really makes the difference is the prospects of the business. If my charitable foundation were operative today, it would have to sell, it would have to give away 5% of the value of the foundation every year. And if Berkshire paid no dividend, that means it would have to sell 5% of the holdings per year. I don't think that the price of Berkshire would be materially different if there were a seller of, that would be, in this case, 2% of Berkshire's capitalization. I don't think it would be materially different. If it is, it probably should be different. I mean, there should be a reasonable amount of trading that can take place annually without affecting the price of the stock materially, or the price of the stock is being propped for sort of unnatural reasons. So I wouldn't really worry about that. We had one shareholder die about a year and a half ago that had 0.75% of the company, for example. It was sold in, I don't know, 6 weeks or thereabouts, and they raised at that time $250 million or thereabouts from the sale. I am not worried about that. I'm worried about, I mean, I don't worry, but the key factor is, what are the prospects of the businesses? If the businesses are worth money, there are all kinds of companies on their stock exchange who are perfectly decent businesses where 30 or 40% of the stock turns over a year, and Berkshire's price should not be way different if 10% trades a year as opposed to the present 3%. Charlie?
I agree with that. I don't think there'd be any problem at all at the present time if the Buffett Foundation were selling 5% of its holdings every year.
Could be 500 shares a week or something like that, but there isn't demand for 500 shares a week of A on a company with our capitalization, then the price probably is artificially wrong at that time.
I just had lunch with Susie, and she doesn't look to me like she's in any imminent danger of mortality.
Yeah, it will come into play when the survivor of the two of us dies, and when the estate gets cleaned up and everything else. So I think, certainly hope, and I think it's quite a ways away.
You people have more important things to worry about.
Zone 3, please.
My name is Jim Howard. I'm from Syracuse, Indiana. My question is, does the book Buffettology by Mary Buffett present fairly, in all material respects, the calculations you used in evaluating the business for purchase, or did the lady just write a book?
Well, it was written by two authors, but I would say that no, I would say that in a general way it gets at the investment philosophy, but I wouldn't say that it's not the book I would have written precisely, but I have no quarrel with it either. I actually think by reading Berkshire's reports, you should be able to get more. I would think you get more of our philosophy than in any other manner. I think Larry Cunningham, the fellow who held the symposium at the Cardozo School at Yeshiva, did the best job actually of sort of reconstructing the various things that have been written at Berkshire into sort of the best organized presentation of our philosophy. So
he's selling it right here. It's a very practical.
Yeah, he had it at Borsheim, in the mall outside Borsheim yesterday, and Larry did a very good job, and I had nothing to do with it, but I think I really think he's done a first-class job of sort of organizing by topic. I mean, all these things that I've sort of written annually, and Charlie's written over time. So that would probably be my, if I were picking one thing to read, that would probably be the one. Okay, Zone 4, please.
My name is Leora Garner. I'm from Los Angeles, California, and I want to begin by thanking you for having Bob Hammond. It was a stroke of genius. I could shop at Borsheim's, and my husband was entertained while I did so.
Well, Bob is not only the best bridge player around, but he is an entertaining guy too.
He's great.
Yeah, he is great. I agree with you.
My question: you owned Disney once before and sold it. You also owned advertising companies in the 70s, I believe.
Right.
And you sold them. Could we have some insight into your thinking as to why you sold them?
I'm not sure I want to give you any insight into that thinking. Well, we'll start off with the fact that when I was 11, I bought some city service preferred at 38, and it went to 200, but I sold at 40. So, grabbing my $2 a share of profit. So everything we've ever sold has gone up subsequently, but some of them have gone up more painfully subsequently than others. And certainly the Disney sale in the 60s was a huge mistake. I should have been buying. I forget about holding. And that's happened many times. I mean, we think that anything we sell should go up subsequently because we own good businesses. And we may sell them because we need money for something else, but we still think they're good businesses, and we think good businesses are going to be worth more over time. So everything virtually that I can think of has gone on to sell it at a lot more money, for a lot more money, and I would expect that would continue to be the case. That's not a source of distress, but I must say that selling the Disney was a mistake, and actually the ad agencies have done very well. Since we sold them too. Now maybe some of that money went into Coca-Cola or something else, so I don't worry about that. I would worry, frankly, if I sold a bunch of things right at the top, because that would indicate that in effect I was practicing the bigger fool type approach to investing, and I don't think that can be practiced successfully over time. I think the most successful investors, if they sell at all, will be selling things that end up going a lot higher because it means that they've been buying into good businesses as they've gone along. Charlie?
Well, I'm glad that the questioner brought this touch of humility because it is really useful to be reminded of your errors. I mean, and I think we're pretty good at that. I mean, we kind of mentally rub our own noses in our own mistakes. And that is a very good mental habit. Warren can tell you the exact number of cents per share that he sold at and compare it with the current price. It actually hurts him.
It actually doesn't hurt. The truth is, because you just keep on doing things. But it is instructive to look at, to do postmortems on everything, and say, as long as you don't get carried away with it. But every acquisition decision, that kind of thing, there should be postmortems done. Most companies don't like to do postmortems on their capital expenditures. I've been a director of a lot of companies over the years, and they've usually not spent a lot of time on the postmortems. They spend a lot of time on telling you how wonderful the acquisitions are going to be or the capital expenditures, but they don't like to look so hard necessarily at the results.
Think of how refreshing the board of directors meeting would be if they sat down and now we'll spend 3 hours examining all our stupid blunders and how much we've blown.
And then after that, the compensation committee will meet. No, that is not going to happen.
Right.
Okay, Area 5, please.
My name is Keller, Harpel Keller from Portland, Oregon. 2 questions, one of a personal nature. Obviously, there are many, many people here today. And I wonder if one of the true patriarchs of the investment business is here today, Phil Curray.
Well,
many of his friends and admirers would wish him well.
Phil, up till a week ago, was going to be here today. Phil is 101. Wrote a book on investments in 1924, and I've known him, Phil, for about 46 or 7 years. And Phil has made all the meetings for a number of years. Would be here today, and he broke a hip about 5 or 6 days ago, but he sent a message that he will definitely be here next year. And he will be, too. Sent a message that he will definitely be here next year. And he will be, too.
Second question has to do with Ben Graham. And he changed his valuation standards as the decades progressed. When he couldn't buy stocks below net, he changed his standards because the environment changed. Now, the world today seems to be at a much different place than in 1989 when the USSR collapsed. Even they are stumbling toward the free enterprise system. The Russian mafia is a perverse illustration of that. Now there is only one superpower in the world, the USA, and we must be extremely grateful for the men who put us on the track to the free enterprise system. Now, the free enterprise system is out of the bottle. It's not going to get back in. It seems to be expanding and accelerating around the world. With the resulting expansion of world trade, may that lead to a reevaluation of historical measures for measuring investments?
Well, my answer to that would be that I doubt it, but I also don't know. But I don't think that the end of the Cold War is something that I would factor into my evaluation of businesses. There are all kinds of events that happen, and their impact in terms of being quantified, very difficult to figure over time. Very difficult to isolate any single variable in a complex economic equation. So in terms of how the world is going to work 10 years from now, or the returns are going to be on on equity in business. I don't know what will be all the variables that impact on that, and obviously right now people are very bullish about the fact that those returns or something like those returns will continue. But I would not rely in making such a projection on the fact that the Cold War has ended or really any political or economic development around the world. I don't know how to predict future earnings of American business. And when I look at all of the great historic events of the past, nothing there gives me much in the way of a clue as to which ones would signal major changes in profitability of American business. Charlie?
Well, I think you raised one very interesting question. If the rest of the world becomes very much more prosperous, as it will if it adopts the free enterprise system, which investments are likely to do best? I would argue that the Cokes and Gillettes and so on are likely to be helped by a great increase in prosperity in what is now the third world. And I'm not so sure that's true of a lot of other businesses.
We like the international businesses we have, and as I say, that our three top holdings all have a major international aspect to them, and really in aggregate a dominant international aspect to them. And there's no question in my mind that a Coke will grow faster outside of the United States than in the United States, and the same is true of Gillette, and really the same is true of American Express. So that's built into our evaluation of those businesses. But I felt that way before 1989 too. I mean, it's very hard to evaluate how the ball is going to bounce generally, but around the world. But it is a plus to have products such as Gillette has or Coke have that have demonstrated the fact that they travel extraordinarily well around the world, that people crave those products, and that they're going to no one's going to find a way to do it better than those two companies in their respective fields. So, and they sell an inexpensive products. So all of that's going for us. But in terms of how stocks generally sell or the profitability of American business generally is in the future, it doesn't help me. Generally sell or the profitability of American business generally is in the future, it doesn't help me anymore.
Hi, my name is Bartley Cohen. I just want to thank you for a great weekend, and my question is, after you bought Dairy Queen, I heard they put Coca-Cola into all the stores, but yesterday when I went to the Nebraska Furniture Mart, they said they don't take American Express. And my question is, do you encourage the subsidiaries and the companies that you have stock to use each other's products, or do you leave it up to the management of the subsidiary?
Well, that's a good question, and it does tell you something about the Berkshire method of operation. We tell each subsidiary to run their business in the way that they think is best for their operation. And Borsheim's takes American Express, See's takes American Express, the Furniture Mart doesn't, for example. But that'll be true in other areas too. If Harvey Golub at American Express, who absolutely done a sensational job for us, if he wants to talk with or have his representatives talk with anybody at any of our operations, we're all for that happening, but we will never tell a subsidiary manager which vendor to patronize or anything of that sort. Once we start making decisions for our managers in that respect, then we become responsible for the operation, and they're no longer responsible for the operation. They are responsible for their operations, and that means they get to call the decisions, and they should do what is best for their subsidiary, and it's up to any other company that wants to do business with them to prove why that is best for them. And that's the Berkshire approach to things. And I think on balance, our managers like it that way. So they're not getting second-guessed, and somebody can't go over their head. I get letters all the time from people who are trying to jump over the heads of our managers, and they want us to say this advertising agency should be used or that and that sort of thing. And it doesn't work at Berkshire. they deal with the managers of the businesses, and they're not going to get around them. Charlie?
I love your answer. It gives Warren lots of time to read annual reports at headquarters.
Area 7.
Hello, my name is Steve Errico. I'm from New York. What do you think is likely to happen with respect to the tobacco settlement, and what do you think should happen? And secondly, McDonald's and Dairy Queen are similar businesses. Was there a relationship between your acquisition of Dairy Queen and the disposal of McDonald's? Thank you.
Yeah, there's no connection in the second case. They have certain similarities, but there's certainly a lot of differences too. You know, a Burger King and McDonald's would be much more similar, or a Wendy and McDonald's, but Dairy Queen is much more of a niche than away from that. The tobacco settlement's interesting, just in terms of watching the dynamics of it, because one of the things in labor negotiations is always a problem is that when you, as a manager, you have a labor negotiation, at the end of the negotiation, you as management are committed, and basically the union isn't, because the union is going to have a vote on it, and that's just the way it is. I mean, you can't get away from that, but it is not fun to be in a negotiating position where you're bound and the other side is not bound. And although that wasn't totally contractually necessarily the situation in the tobacco area, it smelled like trouble to me for the tobacco companies, whether you feel they should have had that trouble or not, but it smelled like trouble to me when they were bound and you had another side that was not bound in any way, and where there were lots of political considerations, and where there was a lot of time was going to expire. I mean, that did not smell to me like a deal that would stick. And I don't know any of the tobacco executives that were involved in that, but I don't know how much they agonized over getting in a position where they were bound and the other party wasn't. But I can tell you from labor negotiations that's not a pleasant place to be, and it's not a great strategic place to be. Charlie, what do you think on that?
I don't feel I've got any great expertise in this situation.
Well, neither did I, but Okay, Zone 8, please.
Hello, I'm Jamie McMahon from Birmingham, Alabama, and I was hoping that Mr. Buffett and Mr. Munger, y'all would expand a little bit on your ideas of an inheritance and the positive and negative influences that can have on your heirs, and what you might be able to do as a business person and an investor and as a parent to sort of mitigate those negative influences.
Yeah, well, I quoted, I think Kay Graham was quoting her father at the time, but some years back, as saying, if you're quite rich, probably the idea of leaving your children enough so they can do anything but not enough so they can do nothing is not a bad formula. I think if you're talking about people that aren't quite rich, I've seen, socially I wouldn't have a system that involved inheritances, but recognizing the situation that exists, I think probably at lower levels, that leaving to the children in this society is perfectly okay. But I believe enough in a meritocracy that if I were devising the system with a consumption tax and everything, I would probably make inheritance a form of consumption, and it would be very heavily taxed. Because I don't believe that because you happen to be come out of the right womb, essentially, that you are entitled to live an entirely different life than somebody who wasn't quite as lucky in terms of womb selection. But in my own case, I follow enough so they can do anything, but not enough so they can do nothing. I think that society showered all these I was very lucky. I was wired the right way at the right time in history to do very well in this kind of a market economy where, as Bill Gates has told me, if I was born some thousands of years ago, I'd been some animal's lunch. I don't run very fast, and there are different assets that are useful at different times, and I'm not wired to play championship bridge or championship chess, or I'm not wired to be a basketball star or anything. It just so happens I'm in an area where it pays off like crazy to be good at capital allocation, and that doesn't make me a more worthwhile human being than anybody else or anything. It just means I was lucky. And should that luck enable many generations of people that I would have some reservations about that. So that's my own feeling on inheritance. But Charlie has a bigger family, and he can give you a better answer.
Well, I feel in a capitalist system that there should be an inheritance tax, and that once that's been imposed and paid, what each person wants to do in his own testamentary arrangements is up to that person. I see very few people that I regard as ruined by money. Many of the people that I see ruined who have money would have been ruined without money. And I think the percentage of the people that are going to be living the life of the French aristocracy before the revolution is always going to be very small, and living the life of the French aristocracy before the revolution is always going to be very small, and there are plenty of grasping people to take the money away from the whole class of incompetents ruling the world as their money cascades ever higher. So I like a fair amount of charity, and certainly some testamentary charity is okay. But I feel it's an individual choice that people have to make.
They get a choice there. Number 9.
My name is Samuel Wong from Irvine, California. I have 2 questions. Question number 1, do you think the USA market is overvalued today? And question number 2, would you buy Berkshire Hathaway stock today? Considering the fact that they have a nice run up? If yes, presuming I have a kid, 20 years old, and he has $150,000 to invest in Berkshire Hathaway, and he won't need the money until 5 years later, gradually, would you recommend to buy A share or B share or the combination? Thank you.
If you decide to buy Berkshire, I don't think it really makes much difference whether you buy A or B. But we don't make any recommendations about whether people buy or sell Berkshire. We never have, and that's a game we don't want to get into. In terms of overvalue, the question of whether the market's overvalued generally, it's simply as we said last year here in the annual report. The general market is not overvalued if 2 conditions are met, which is, in our view, which is that interest rates remain at or near present levels or go lower, and that corporate profitability in the U.S. stay at the present or close to the present levels, which are virtually unprecedented. Now, those are a couple of big ifs, as we pointed out. A lot of the stories that came out after the annual report would emphasize one aspect or another, but it's simply, and they say, what does he mean by that? Well, it means exactly what I say. If the 2 conditions are met, I think it's not overvalued, and if either of the conditions is breached in an important way, I think it will turn out to be overvalued, and I don't know the answer, which is why I put it in the form that I did. It's very tough at any given time to look forward and know what level of valuation is justified. You do know when certain dangerous things appear, and certainly if you're predicating your answer that stocks are okay at these prices you have, if you come to that conclusion, you have to also come to the conclusion that, in our view, that corporate earnings at present levels are likely to be maintained. And that's a conclusion you would have to come to. I don't think it's obvious that that's the case. Area 10, please.
Good afternoon. My name is Jamie Harmon, and I'm from Boston. You say that companies should only spend $1 on capital expenditures if it will create more than $1 of market value. I'm wondering, how do you determine this? Is it based on A, historical returns on capital, B, a qualitative judgment of the company's competitive position, historical returns on capital, B, a qualitative judgment of the company's competitive position, a quantitative projection of the returns on capital, or D, something else?
We can say, to date, every dollar we've retained has been worthwhile, because on balance, those dollars have produced more than $1 of market value, and it's actually, with a great many companies, you could say that now, because things have turned out so well. But it would be a case, the check on it is if after 3 or 4 years you found that the dollars we retained haven't created more than value, then the presumption becomes very strong at that point that we should start paying out money. But almost any management that wants to retain money is going to rationalize it by saying we're going to do wonderful things with the money we retain. And we think there should be checks on that, which is why in the report, in the ground rules, I suggest making checks on the validity of those projections. Charlie and I, if you asked us today whether the single dollar we retain from the earnings today, we've got a use for today that will produce more than $1 of value, the answer is no. We do think that based on history, that the prospects are that better than 50%, well over 50%, that in the next few years we would have an opportunity to do that. But there's no certainty to it. Charlie?
Nothing more.
Okay. Area 1, please. Charlie?
Nothing more.
Okay. Area 1, please.
Good afternoon. My name is Gary Bialis. I'm from Southern California. I want to thank you again for producing Can you tell me if the rule of thumb is still applicable regarding the statement in the owner's manual that the percent increase in the book value tracks pretty well the percent increase in intrinsic value? Or is the fact that you now have more owned businesses, especially ones like Geico and Flight Safety, mean that the spread between those two is possibly narrowed?
Well, the two have tracked pretty well over the years. I mean, compared to the record of most businesses that are publicly owned, I would say that over the 33 or so year span, our market price has tracked intrinsic value more closely than 80 or 90% of the companies that we view, probably 90%. But that doesn't mean it does it all the time. And there are times when the market, but that doesn't mean it does it all the time. And there are times when the market has the change in intrinsic value, and there are times when obviously then that it will lag behind. So it's far from perfect, but it's better than most. Ideally, we would like it to track it perfectly. If we ran this as a private company and we met once a year and set a price on the stock to have it traded once a year, and Charlie and I were responsible for setting that price, we would try to set a price that was as close to intrinsic value as we could, and that would be, to the extent that we could do it, it would be a perfect tracking. The market isn't like that, and the market responds to a lot of other things. So it's not perfect. It's not getting more perfect in our view, but we still think that Berkshire companies. Charlie? Companies. Charlie?
Nothing to add.
I'm Elizabeth Cruz from New York City. I have a question about Gillette. Another significant Gillette investor, KKR, recently sold over $1 billion in Gillette shares that they had acquired through Gillette's acquisition of Duracell. Knowing that KKR has also been a successful investor, Do you see this as a negative signal about Gillette's future prospects, particularly on the eve of the launch of the Mach 3 razor? And what do you think their plans are for the remainder of their shares?
Well, I think they may have even publicly stated, I'm pretty sure they have, the Duracell shares, from which the Gillette shares came, were held by a specific investment fund that was formed in I don't know what year, but a given year, and which is scheduled to disband at a certain point. So those shares, whether they were of Duracell or whether they're of Gillette, were scheduled for disposition at some point within a given term. And I think that KKR made the decision, and they've made it with other stocks too, is to have maybe 3 or so offerings between now and that terminal date for their partnership. And why they pick any any given date, is up to them and their advisors. It means nothing to us. I mean, if they didn't have that kind of a fund and they decided to sell, it wouldn't make any difference to them. And I presume if we made a decision to sell, it wouldn't make any difference in their case. So we form our ideas of valuation independent of anybody else's thinking on it. But in the case of KKR specifically, they have a termination date on a partnership that own those shares and have to dispose of them one way or another between now and the termination date, and probably decided that with the quantity of stock they had that they were going to have several sales. The Mach 3 is terrific in quantity of stock they had that they were going to have several sales. The Mach 3 is terrific, incidentally. I've been using Mach 3. Area 3, please.
I'm Gertrude Goodman from Palm Springs, California. Mr. Buffett and Mr. Munger, there are many stocks that rise and eventually split. My question is, do you foresee in the near future a split for Berkshire Hathaway Class A?
Well, that's an easy one. No, the answer is no. We have no plans to split the A. In effect, we let people who want to split the A split it themselves into a B. So anybody that owns the A can have a 30-for-1 split any morning they wake up and want to have such a split. And Charlie, do you have any additional comment?
No, I think you said no perfectly.
We don't take that attitude because we're cavalier about how shareholders feel. We really think that in the long-range interests of Berkshire, that the policy we followed on not splitting has benefited the company and shareholders. Nothing dramatic about it, but I think that we have a better class of shareholders in aggregate in this room than we would have if we were selling at $3 a share or $30 a share or maybe even $300 a share. Area 4, please.
Good afternoon, Mr. Buffett and Mr. Munger. My name is Jack Sutton from New York City. I have 2 questions. The Japanese stock market has been likened to the U.S. market in 1974. With Japanese stocks selling at very low price-to-book values as compared to U.S. stocks, would it not make sense to invest in a basket of Japanese stocks or an index fund of Japanese stocks? Question number 2. Berkshire Hathaway tends to invest in companies with high margins and high return on common equity. Berkshire's investment in the airline business seems to have digressed widely from those principles. Could you elaborate on why Berkshire invested in the airline industry, and would Berkshire consider new investments in the industry in the future?
Now, going to the first question, the reason that, and I don't know the exact figures, the Japanese stocks would sell at a lower price-book ratio than U.S. stocks is simply because Japanese companies are earning far less on book than American companies, and earnings are what determine value, not book value. Book value is not a factor we consider. future earnings are a factor we consider. And as we mentioned earlier this morning, earnings have been poor for a great many Japanese companies. Now, if you think that the return on equity of Japanese business is going to increase dramatically, then you're going to make a lot of money. I mean, and you're correct, you're going to make a lot of money in Japanese stocks, but the return on equity for Japanese businesses has been quite low, and that makes a low price to book ratio very, very appropriate, because earnings are measured against book. And if a company's earning 5% on book value, I don't want to buy it at book value if I think it's going to keep earning 5% on book value. So a low price book ratio means nothing to us. It does not intrigue us. In fact, if anything, we are less likely to look at something that sells at a low relationship to book than something that sells at a high relationship to book, because the chances are we're looking at a poor business in the first case and a good business in the second case. What was the other question on, Charlie?
Buying it.
Airlines. Oh,
yes,
I always repress everything on airlines. I don't want to. We've never bought an airline common stock that I can remember. So what we did was we lent money to U.S. Air for a 10-year period, and we had a conversion privilege there. It looked like it was a terrible mistake. I made the mistake, but we got bailed out. But we never made the determination. When we bought our stock, U.S. Air was selling at $50 a share or thereabouts, the common. And we didn't have an interest in buying U.S. Air at 50 or 40 or 30 or 20. And we got a chance to as things went along, all the way down to 4. And we never bought it. And we never bought American or United or Delta or any other airline. It is not a business that intrigues us. We did think it was intriguing to lend money to them with a conversion privilege, and it's worked out now because we got lucky, and because Steve Wolf came along and really rescued the company from right at the brink of bankruptcy. But we're unlikely to be in airlines, although, again, we wouldn't mind lending money to a lot of businesses that we wouldn't buy common equity in. I mean, that could happen again in various industries, including the airline industry. Charlie, do you have anything to say on either the airlines or the Japanese market?
Well, the airline experience was very unpleasant for us. The net worth just melted. It was like $1.5 billion, and it just went 100 million, 100 million, 100 million. And finally the cash is running down. It is a very unpleasant experience. And we try and learn from those experiences, but we're very slow learners.
Japanese market? Yeah.
Oh, the Japanese market. I suppose anything could happen. After all, we bought silver. But we have never made a big sector play on a country. In fact, we've almost never made a big sector play.
We would have to come to the conclusion the Japanese business, instead of earning whatever it's earning on equity now, is going to earn appreciably more on equity. I've got no basis for I wouldn't argue with anybody else feels that way. I wouldn't argue with them, but I have no basis for coming to that conclusion. And unless you come to that conclusion, you're not going to make good returns. I mean, unless that happens, you're not going to make good returns from Japanese stocks. You can't earn a lot of money from businesses that are earning 5% on or 6% on equity. And I look at the reports, but I don't see the earning power now. Now maybe it'll all change. I mean, there's talk of, well, there's already been a small temporary tax cut, but corporate tax rates are quite high, as you know, in Japan, and they used to be 52% here in the United States. Now they're 35%. So you could have things happen that increase corporate profits, but I don't have any special insight into that anyone that reads the press generally would not have.
There are also readings in corporate culture that have to be made. Owning stock in a corporation where you know that if shareholders or somebody else has to suffer, the choice is likely to be that somebody else will be chosen. That is a different kind of a company to invest in than one that thinks that the principal purpose of life is to keep some steam boiler company going in a particular community or something, no matter how much the shareholders suffer. I think it's hard to judge corporate culture in the foreign countries as well as we can judge it in our own.
Area 5.
Yvonne Edmonds from Cedar Mountain, North Carolina. I have a specific question, but not a trivial one. You regularly compare Berkshire Hathaway's performance to the S&P 500, which is very helpful and very interesting. But I haven't seen a correlation coefficient between the S&P 500 daily, from day to day performance, close, say, and Berkshire Hathaway's close. Now, it so happens for me, and I'm sure some other people in the audience, that I don't always have access to newspapers, or the internet for that matter, newspapers that publish Berkshire Hathaway performance on a daily basis, or even a weekly basis for that matter, or a monthly basis. It would be very helpful to know the extent of a correlation coefficient between those two variables. If you have that, would you let us know what it is? And if you don't, would you please consider calculating it in the future?
Well, it could be calculated, but I don't think it would have much meaning. I mean, it would be an historical correlation coefficient, which, you know, I would be very reluctant to have people place any weight in. I try to indicate even the limitations of the yearly comparison of the relative performance, because what was doable by us in the past is not doable today. I mentioned in my annual report the best decade I ever had on comparative performance by far was the 50s. Now, I don't think it was because I was a lot smarter then. I'm unwilling to accept that. But, you know, I had some edge of, well, there's probably 40 plus points per year. But I was working with it. That has no relevance to today whatsoever. It would be misleading to publish it or to make calculations based on it. So I think that you would find, I don't know what you'd find on a specific correlation between Berkshire and the S&P. You'd find a lot of correlation. Well, you might not find so much even. You'd find it in intrinsic value between that and Coke and a few stocks like that. But I don't really think that's particularly useful information going forward. We'd have no objection if anybody wants to make the calculation, but it wouldn't be something that would be of any utility to us. And if we don't think it's of utility to us, we don't want to put it out for shareholders as being a possible utility. We do think that the S&P annual calculation has some meaning because it's an alternative for people to invest. They don't need us to buy the S&P. So unless over time we have some advantage over that, you know, what are we contributing? What value is added by our management? So we think that people should hold us accountable, even though we would prefer not to be, because that it is a tough comparison for us as a tax-paying entity against the pre-tax calculation on the S&P. But we don't pay any attention to beta or any of that sort of thing. It just doesn't mean anything to us. We're only interested in price and value, and that's what we're focusing on all the time. And any kind of market movements or anything don't mean anything. I don't know what Berkshire is selling for today, and it really makes no difference. You know, it just doesn't make any difference. What does count is where it is 10 years from now. And I can't tell you what it was selling for on May 4th, 1983 or May 4th, 1986. So I don't care what it sells for on May 4th, 1998. I do care, you know, where it is in general 10 years from now. And that's where all the focus is. Charlie?
Yeah, we're publishing data in the form where we would like it if we were the passive shareholder. And So you're getting the data and you're getting it on a time schedule based on what we would want if we were in your position. And we don't think the correlation coefficients would help us.
We don't think anything that relates either to volume, price action, relative strength, any of that sort of thing. And bear in mind, when I was in my teens, I used to eat that stuff up. I mean, I was making calculations based on it all the time and kept charts on it and even wrote an article or two on it. But it just has no place in the operation now.
One of the pleasant things about dealing with Warren all these years is he's never talked about a correlation coefficient. If the correlation isn't so extreme you can see it with the naked eye, he doesn't compute it.
Okay, we're going to go to Zone 6, and I'm going to have a dilly bar, and Charlie's got one here, too. These are terrific.
My question has to do with what you mentioned earlier about how companies have to reinvest a certain amount of cash in their business every year just to stay in place. And if one could say that the best businesses are the ones that not only throw off lots of cash, but can reinvest it in more capacity. But I suppose the paradox is that the better a company's opportunities for making expansionary capital expenditures, the worse they appear to be as consumers of cash rather than generators of cash. What specific techniques have you used to figure out the maintenance capital expenditures that you need to do in order to figure out how much cash a company is throwing off? What techniques have you used on Gillette or other companies that you've studied?
Well, if you look at a company such as Gillette or Coke, you won't find great differences between their depreciation. Forget about amortization for the moment, but depreciation and sort of the required capital expenditures. If we got into a hyperinflationary period, or I mean, you can set up cases where that wouldn't be true, but by and large, the depreciation charge is not inappropriate in most companies to use as a proxy for required capital expenditures, which is why we think that reported earnings plus amortization of intangibles usually gives a pretty good indication of earning power. And I've never given a thought to whether Gillette needs to spend $100 million more, $100 million less than depreciation in order to maintain its competitive position. But I would guess the range is even considerably less than that versus its recorded depreciation. The businesses you have to worry about, I mean, an airline business is a good case. In airlines, you just have to keep spending money like crazy, and you have to spend money like crazy if it's attractive to spend money, and you have to spend it the same way if it's unattractive. It's part of the game. Even in our textile business, to stay competitive, we would have needed to spend substantial money without any necessary, any clear prospects of making any money when we got through spending it. And those are real traps, those kind of businesses, and they may work out one way or another, but they're dangerous. And in a See's candy, we would love to be able to spend $10 million, $100 million, $500 million and get anything like the returns we've gotten in the past. But there aren't good ways to do it, unfortunately. We'll keep looking. But it's not a business where capital produces the profits. At flight safety, capital produces the profits. You need more simulators as you go along, and more pilots are to be trained, and so capital is required to produce profits. But it's just not the case at See's. And at Coca-Cola, particularly when new markets come along, the Chinas of the world or East Germany or something of the sort, the Coca-Cola company itself would frequently make the investments needed to build up the bottling infrastructure to rapidly capitalize on those markets, the old Soviet Union. So those are expenditures. You don't even make the calculation on them. You just know you've got to do it. You've got a wonderful business and you want to have it spread worldwide, and you want to capitalize on it to its fullest. And you can make a return on investment calculation, but as far as I'm concerned, it's a waste of time because you're going to do it anyway. And you want to dominate those markets over time. And eventually, you'll probably fold those investments into other bottling systems as the market gets developed. But you don't want to wait for conventional bottlers to do it. You want to be there. One of the ironies, incidentally, it might get a kick out of some of the older members of the audience, that when the Berlin Wall went down and Coke was there that day with Coca-Cola for East Germany, that Coke came from the bottling plant at Dunkirk. So there was a certain poetic irony there. Charlie, do you have anything on that?
I've heard Warren say since very early in his life that the difference between a good business and a bad business is usually that good business just throws up one easy decision after another, whereas the bad business gives you a horrible choice where the decision is hard to make. And is this really going to work? Is it worth the money? If you want a system for determining which is a good business and which is a bad business, just see which one is throwing the management bloopers time after time after time. Easy decisions. It's not very hard for us to decide to open a new See's store in a new shopping center in California that's obviously going to succeed. It's a blooper. On the other hand, there are plenty of businesses where the decisions that come across your desk are just awful. And those businesses, by and large, don't work very well.
I've been on the board of Coke now for 10 years, and we've had project after project come up, and there's always an ROI, but it doesn't really make much difference to me because in the end, almost any decision you make that solidifies and extends the dominance of Coke around the world in an industry that's growing by a significant percentage and which has great inherent underlying profitability, the decisions are going to be right. And you've got people there that will execute them well.
You're saying you get blooper after blooper.
Yeah. And then Charlie and I sat on U.S. Air, and the decisions would come along, and it would be a question of, do you buy the Eastern Shuttle or whatever it may be, and you're running out of money, and yet to play the game and to keep the traffic flows such as with connecting passengers and everything, you just have to continually make these decisions, whether you spend $100 million more on some airport, and they're agony, because, again, you don't have any real choice. But you also don't have any real conviction that it's going to translate, those choices are going to, or lack of choices, are going to translate themselves into real money later on. So one game is just forcing you to push more money into the table with no idea of what kind of a hand you hold. And the other one, you get a chance to push more money in knowing that you've got a winning hand all the way. Charlie? Why'd we buy U.S. Air? Could have bought more Coke. Area 7.
My name is Bakul Patel. I am from upstate New York. My question is Berkshire prepared for 1929 style of depression or like a prolonged bear market that exists in Japan? 1929 style of depression or like a prolonged bear market that exists in Japan?
Well, we don't expect what you're talking about, but we're probably about as well prepared as any company can be for adversity because Berkshire has been built to last. Net, we would benefit over a 20-year period by having some periods of terrible markets periodically in that 20-year period. That doesn't mean we're wishing for them, and it doesn't mean they're going to happen, but we make our money by allocating capital well, and the lower the general stock market would be, the better we can allocate capital. So we're well prepared, but we're not necessarily expecting. Charlie?
Yeah, we are not going to ever sell everything and go to cash and wait for the crash so we can go back in. On the other hand, we are structured so that I think net a lot of turmoil in the next 20 years will help us, not hurt us. I don't mean it'll be pleasant to go through the down cycle, but it's part of the game.
Area 8.
My name is Pete Banner from Boulder, Colorado. First of all, Mr. Buffett and Mr. Munger, thank you for your genuine generosity today. Berkshire closed yesterday. The A share was about, or Friday, $69,000, and the B share was about $2,300. Do you feel that price is grossly overpriced, or grossly underpriced, or reasonably priced?
Well, I'll let Charlie answer that one.
I'm not going to say.
No, we're just never going to give out advice on Berkshire stock. There's no, that is up to people who want to buy and sell it, and anything we would say could easily get magnified, and people would be acting on it months later, and who knows all the problems that it could produce. So
it would be quite eccentric if we were to every day put out an announcement, now's the time to buy, now's the time to sell our own stock. Eccentric we are, but that eccentric we aren't.
Area 9.
I'm Irene Finster, your longtime partner from Tulsa, Oklahoma.
Hi, Irene. Yeah, Irene has a soda fountain. You ought to go visit her.
First, I want to thank you for giving your shareholders the opportunity to select their own charities. And second, I'm very concerned about your health due to your diet of red meat.
Irene, these are our products that I'm eating.
red meat, candy, ice cream,
and that's just what I do. That's what I do in public.
And Cokes. And I want to know what your doctor says.
My doctor says I must be heavily relying on my genes. Now, I will tell you, I mean, Charlie and I are both very helpful. If you were in the life insurance business, you would be happy to write us at standard rates, I can assure you.
They asked George Burns when he was 95, what does your doctor say about smoking these big black cigars? And he said, my doctor's dead.
Charlie and I played bridge with George when he was about 97, I'd say, at the Hillcrest Country Club, and there was a big sign behind him that said, no smoking by anyone under 95. And actually, at his 95th birthday party, he had about 5 very good-looking young girls that were there to greet him with a big cake and everything, and he looked them over one after another, and he said, oh, girls, he said, I'm 95. One of you is going to have to come back tomorrow. We're very big on George Burns in recent years. Area 10.
My name is Hubert Vos. I'm from Santa Barbara, California. Earlier this morning, you made a comment that if the market fell, you would be spending less time on the internet because you'd be very busy. And this has reinforced an impression I have had that the cash flows of Berkshire Hathaway are enormous, but that possibly in the last 12 months, you've been investing less than you had previously. And if so, if this is correct, what does that say about waiting for attractive values? How long are you willing to wait? And what does that say to the investment public in their own habits?
Well, you're correct that we have not found anything to speak of in equities in a good many months. And the question of how long we wait, we wait indefinitely. We are not going to buy anything just to buy something. We will only buy something if we think we're getting something attractive. And incidentally, if things were 5% cheaper, or 10% cheaper, that wouldn't change anything materially. So we have no idea when that period ends. We have no idea whether. So we have no idea when that period ends, we have no idea whether if return on equity stay where they are, but they are, even then they aren't in the least mouth-watering. So we won't feel we've missed anything particularly if returns stay where they are, because if it turns out that these levels are okay, they still will not produce great returns from here in our view. That doesn't mean you couldn't have a tremendous market in the short term or something of the sort. You know, markets can do anything. I mean, you look at the history of markets and you just see everything under the sun. But we will not, you know, we have no time frame. If the money piles up, the money piles up, and when we see something that makes sense, we're willing to act very fast, very big, but we're not willing to act on anything that doesn't check out in our view. You don't get paid for activity, you only get paid for being right. Charlie?
Yeah, an occasional dull stretch for new buying, this is no great tragedy in an investment lifetime. And other things may be possible in such an era too. I mean, it isn't like we have a quiver with only one arrow.
We sat through periods before. I mean, the most dramatic one being the early 70s, late 60s and early 70s. For a long time, it doesn't seem so long when you look back on it. It seems long when you're going through it, but it's like having a tooth pulled or something. But it's, you know, what can you do about it? The businesses aren't going to perform better in the future just because you got antsy and decided you had to buy something. We will wait till we find something we like. We'll love it when we can swing in a big way, though. That's our style. Area 1?
Larry Pikowski, Millburn, New Jersey. Berkshire seems never to have made any pure real estate investments, with the not counting facilities the operating companies might own, with the exception of Wesco's involvement in the residential project in California. I was wondering if you've ever looked at a real estate transaction and tried to apply the same filters, meaning competitive advantages, returns on capital, that you do in operating companies. And if not, is it a circle of competence issue, or is there something you find disinteresting about real estate?
You want to take it? Okay, Charlie wants to take this one.
Let me take this one because here's a area where we have a perfect record that extends over many decades. We have been demonstrably foolish in almost every operation that had to do with real estate we've ever touched. Every time we had a surplus plant and didn't want to hit the bid and let some developer kind of take an unfair advantage of us, we would have been better off later if we'd hit the bid and invested the money in fields where we had the expertise. That housing tract that I developed because I didn't want to let the zoning authorities rob me the way they wanted to. I wish I had let them. We have a certified record of failure in this field.
And the funny thing is we understand real estate.
And we're good at it. Right.
But that actually is a correct aside. We do understand real estate. And Charlie got to start in real estate.
Yeah, but we understand other things better. And so the chances that we're going to be big in real estate are low.
Yeah. We've seen lots of things, and the prices just don't intrigue us in terms of what we get for our money. I tried to buy a town when I was 21 years old. The U.S. government had a town in Ohio for sale, and would have worked out very well. There's nothing about the arena that turns us off, but we don't see great returns available, and like Charlie says, the few things, particularly having an old plant or something, we have not been great at working our way out of those. Fortunately, they haven't been very important in relation to the net worth of Berkshire. Area 2?
Good afternoon. My name is Fred Castano from Detroit, Michigan. My question concerns Nike. Nike is a company experiencing some short-term problems, but is a great company with an excellent track record. Phil Knight is similar to Bill Gates in the respect that he's a marketing genius and is a very hard worker. Making sneakers is a very simple business with high margins. How do you view Nike, and what do you think of the company?
Well, I think Phil Knight is a terrific operator. I think, and he's a competitor. He's got a lot of money in Nike, but in terms of what we think of the stock, you know, we keep all of those views to ourselves pretty much. Area 3.
Hello, my name is Ed Clinton. I'm from Chicago, Illinois. I'm wondering about the tobacco litigation. There's also have been some comments about fatty food. Do you think there's going to be a new trend of fatty food litigation coming out of the tobacco problems?
Well, I sign a waiver before I do any of that myself. No, I would doubt. I do not see those two as being remotely similar. But, Charlie, do you have any different views on that?
Well, I think the traditional tort system is particularly ill-suited for solving what might be called the tobacco health problem. So I regard that whole thing as sort of a Mad Hatter's Tea Party. And we sit out from afar.
Area 4.
Yes, I'm Fred Bunch from near Tightwad, Missouri. In light of the current...
What was the name of that town?
Tightwad, Missouri.
Tightwad, Missouri, huh?
There's a bank there.
Oh. Did they name it after me or Charlie?
Well, neither one, really. You'd both fit in. In light of today's healthy growth and stability of the American economy at the present time and over the last 5 years or so, how much credit, if any, do you give the Clinton administration, and why?
Well, I give credit to going back to Volcker, significant credit to Volcker. I give credit to Reagan, going back to Volcker, significant credit to Volcker. I give credit to Reagan, certainly to Greenspan and to Rubin. And the tax bill was very important, carried by one vote, and I think he may listen to Rubin. So I think there's a lot to give credit for, and I think you can spread it around a fair amount. Charlie may be less charitable here, but let's see.
No, I've got no great quarrel with the way the country's economy is performed. I think it's way better than any of us would have predicted.
Area 5.
My name is Travis Keith. I'm from Dallas, Texas. And my question regards what Philip Fisher referred to as scuttlebutt. When you've identified a business that you consider to warrant further investigation, more intense investigation, how much time do you spend commonly, both in terms of total hours and in terms of the span in weeks or months that you perform that investigation over?
Well, the answer to that question is that now I spend practically none because I've done it in the past. And one advantage of allocating capital is that an awful lot of what you do is cumulative in nature, so that you do get continuing benefits out of things that you've done earlier. So by now, it's cumulative in nature, so that you do get continuing benefits out of things that you've done earlier. So by now, to the businesses that might qualify. But when I started out, and for a long time, I used to do a lot of what Phil Fisher described. I followed this scuttlebutt method, and I don't think you can do too much of it. Now, the general premise of why you're interested in something should be 80% of it or thereabouts. I mean, you don't want to be chasing down every idea that way, so you should have a strong presumption. You should be like a basketball coach who runs into a 7-footer on the street. I mean, you're interested to start with. Now you got to find out if you can keep him in school, if he's coordinated and all that sort of thing. That's the scuttlebutt aspect of it. But I believe that as you're acquiring knowledge about industries in general, companies specifically, that there really isn't anything like first doing some reading about them and then getting out and talking to competitors and customers and suppliers and ex-employees and current employees and whatever it may be, and you will learn a lot. But it should be the last 20% or 10%. I mean, you don't want to get too impressed by that, because you really want to start with a business where you think the economics are good, where they look like 7-footers, and then you want to go out with a scuttlebutt approach to possibly reject your original hypothesis, or maybe and if you confirm it, maybe do it even more strongly. I did that with American Express back in the 60s, and essentially the scuttlebutt approach so reinforced my feeling about it that I kept buying more and more and more as I went along. If you talk to a bunch of people in an industry and you ask them what competitor they fear the most and why they fear them and all of that sort of thing, you know, who would they use the silver bullet of Andy Groves on and so on, you're going to learn a lot about it. You'll probably know more about the industry than most of the people in it when you get through, because you'll bring an independent perspective to it, and you'll be listening to everything everyone says rather than coming in with these preconceived notions and just sort of listening to your own troops after a while. And I advise it. I don't really do it much anymore. I do it a little bit, and I talked in the annual report about how when we made the decision on keeping the American Express when we exchanged our perks for common stock in 1994, I was using the scuttlebutt approach when I talked to Frank Olson. I couldn't have talked to a better guy than Frank Olson. Frank Olson, running Hertz Corporation, lots of experience at United Airlines, and a consumer marketing guy by nature. I mean, he understands business, and when I asked him how strong the American Express card business, and when I asked him how strong the American Express card, I mean, he could give me an answer in 5 minutes than I could accomplish in hours and hours and hours or weeks of roaming around and doing other things. So you can learn from people, and Frank was a user of it. I mean, Frank was paying X% to American Express for his Hertz cars, and Frank doesn't like to pay out money, so why was he paying that? And if he was paying more than he was paying on MasterCharge or Visa, why was he paying more? And what could he do about it? I mean, you just keep asking questions. And I guess Davey explained that in that video we had ahead of time. I'm very grateful to him for doing that, because that was a real effort for him. But that was really what I was doing back in 1951 when I visited him down in Washington, because I was trying to figure out why people would insure with Geico rather than with the companies that they were already insuring with, and how permanent that advantage was, and what other things could you do with that advantage? And there were just a lot of questions I wanted to ask him, and he was terrific in giving me the answers. It changed my life in a major way. So I've got nobody to thank but Davey on that. But that's the scuttlebutt method, and I do advise it. Charlie?
Nothing to add.
Area 6.
Hi, my name is Richard Lontoc from Toronto, Canada. I have a question for both of you. Mr. Buffett, Berkshire Hathaway's earnings in 1997 is less than that of 1996. What do you intend to do in 1998 to improve that earning? And Mr. Munger, I've been watching you and Mr. Buffett eating the See's candies and drinking the Coca-Cola the whole day.
Join in.
Do you intend to do any commercials in the future like what Dave Thomas does with Wendy's?
Which of us do you think we should do them? Now you're talking.
We aren't old enough to be really good in a commercial. What we would like to do is have somebody up here happily eating See's candy and answering these questions who's about 110 years old. That would really be helpful.
In terms of the earnings, the final bottom line GAAP reported earnings that mean absolutely nothing at Berkshire to us. Now the look-through earnings, which we publish, do have some meaning, but even those have to be interpreted in terms of whether there was a super cat occurrence or whether Geico had an unusually good year, and we try to mention those factors. But we do hope that the look-through earnings do build at a reasonable clip over time. But our final earnings include capital gains, and we can report those in any number that we wanted to, and we pay no attention whatsoever to realize capital gains at Berkshire. The IRS does, but and that's why we may send them $1 billion or more this year. But they mean nothing in terms of measuring our progress. The look-through earnings say something about it. That table, the first couple of pages, it shows our change in book value versus the S&P, says something about it. Not perfect. The real test is the gain in intrinsic value per share over time, and that there's no hard number for that. But so far, Charlie and I judge it satisfactory, but we also judge it as non-repeatable. Charlie, any more?
No.
Area 7, please.
Good afternoon, Mr. Buffett and Mr. Munger. My name is Keiko Mihalik, and I'm an MBA student at Wharton, but please don't hold that against me.
We won't. I never made it that far. I was an undergraduate student.
Could you please explain how you differentiate between types of businesses in your cash flow valuation process, given that you use the same discount rate across companies? For example, in valuing Coke and Geico, how do you account for the difference in the riskiness of their cash flows?
We don't worry about risk in the traditional, the way you're taught actually at Wharton. But it's a good question. Believe me. But if we could see the future of every business perfectly, it wouldn't make any difference whether the money came from running streetcars or from selling software, because all the cash that came out, which is all we're measuring between now and Judgment Day, would spend the same to us. The industry that it's earned in means nothing except to the extent that it may tell you something about the ability to develop the cash, but it doesn't tell you, it has no meaning on the quality of the cash once it becomes distributable. We look at riskiness essentially as being sort of a go, no-go valve in terms of looking at the future businesses. In other words, if we think we simply don't know what's going to happen in the future, that doesn't mean it's necessarily risky. It just means we don't know. It means it's risky for us. It may not be risky for someone else who understands the business. In that case, we just give up. We don't try to predict those things. And we don't say, well, we don't know what's going to happen, so therefore we'll discount it at 9% instead of 7%, some number that we don't even know. That is not our way to approach it. We feel that once it passed a threshold test of being something about which we feel quite certain, that the same discount factor tends to apply to everything. And we try to do only things about which we're quite certain when we buy into the businesses. So we think all the capital asset pricing model type reasoning with different rates of risk-adjusted return and all that, we tend to think it is, well, we don't tend to, we think it is nonsense. And but we do think it's also nonsense to get into situations or to try and evaluate situations where we don't have any conviction to speak of as to what the future is going to look like. And we don't think you can compensate for that by having a higher discount rate and saying it's riskier so that I don't really know what's going to happen, I'll have a higher discount rate. That just is not our way of approaching things. Charlie?
Yeah, this great emphasis on volatility in corporate finance, we just regard as nonsense. If we have a statistical probability of putting out $1 million and having it turn into put it this way, as long as the odds are in our favor and we're not risking the whole company on one throw or anything close to it, we don't mind volatility in results. What we want is the favorable odds. We figure the volatility over time will take care of itself at Berkshire.
If we have a business about which we're extremely confident as to the business result, we would prefer that it have high volatility than low volatility. We will make more money out of a business where we know where the end game is going to be if it bounces around a lot. I mean, for example, if people reacted to the monthly earnings of C's, which might lose money 8 months out of the year and makes a fortune, in November and December. If people reacted to that and therefore made its stock as an independent company very volatile, that would be terrific for us because we would know it was all nonsense, and we would buy in July and sell in January. Well, obviously things don't behave that way, but when we see a business about which we're very certain, but the world thinks that its fortunes are going up and down, and therefore it behaves with great volatility, we love it. That's way better than having a lower beta. So we think that we actually would prefer what other people would call risk. When we bought the Washington Post, I've used that as, it went down 50% in a matter of a few months. Best thing that could have happened. I mean, that doesn't get any better than that. Business was fundamentally very non-volatile in nature. I mean, TV stations and a strong dominant newspaper, that's a non-volatile business, but it was a volatile stock. And that is a great combination from our standpoint. Area 8.
Good afternoon, and thank you for staying around to answer our questions. I have two. First of all, would you give us what logic went into your decision to both buy and sell McDonald's? And my second question goes to a term that you've used. You've talked about the caliber of the shareholders of Berkshire Hathaway. How do you define the caliber, and what difference does it really make?
Well, it makes a lot of difference, and our idea of a high caliber group is one that is just like us. And that's not entirely facetious in that we basically want shareholders who look at the business the same way we do, because we're going to be around running something, and what could be worse than having a group out there had a whole different set of expectations than we did, and that evaluated us in a different way, or all of this sort of thing. I mean, if you are going to you're going to have a given number of shares outstanding. Let's say we have the equivalent of 1,200,000 and some thousand A shares. Somebody's going to own every single share. Now, would you rather have them owned by people who understand your business, who understand your objectives, who measure you the same way you do, who have similar time horizons, or would you rather have the reverse? It makes a real difference over time to be in with people that are compatible with you. So it's a significant plus to us, the operation of the business, and it leads to a more consistent relationship between price and intrinsic value when you have a group like that, because they understand themselves and they understand the business, and they're not likely to do silly things in either direction. So you get a much more consistent relationship than if we had a whole bunch of people who were thinking that the most important thing in evaluating this business was next quarter's earnings. The question about McDonald's simply is, it's an outstanding business, and we don't talk about it when we buy it. We don't talk about it if we sell it. Charlie?
Yeah, the question of what difference does it make to the management who the shareholders are? Well, if you are into what I call trustee capitalism, where the shareholders aren't just a faceless bunch of nothings, but you feel as a kind of a hair shirt an obligation to do as well as you can by the shareholders, well, wouldn't you rather feel an obligation to people you liked instead of people you didn't like?
Yeah, let's say you were running a business and you had a choice of 3 owners. You could have 100% of it owned by whatever your favorite philanthropy is. You could have 100% of it owned by the U.S. government, and you could have 100% owned by the worst person you can think of in your hometown. I mean, I think it would make a difference in how you felt about going to work every day. Number 9.
Yes, my name is Steve Check. I'm from Southern California, and my question has to deal with kind of quality versus price. I've been to 3 annual meetings and have heard great things about Coke every year, but as far as I'm aware, you have not bought any additional shares of Coke over the last 3 years, even though the stock has done just fine. If an investor has a relatively short time frame, say 3 to 5 years, how much weight do you think one should give to quality versus price?
Well, if your time frame is 3 to 5 years, I wouldn't advise it being that way, because I think if you think you're going to get out, then it gets more leaning toward the bigger fool theory. The best way to look at any investment is how will I feel if I own it forever, and put all my family's net worth in it. But we basically believe in buying, if you talk about quality, meaning the certainty that the business will perform as you expect it to perform over a period of time, so the range of possible performance is fairly narrow. That's the kind of business we like to buy, and all I can say is that we like to pay a comfortable price, and that depends to some extent on what interest rates are. We haven't found comfortable prices for the kind of businesses we like in the last year. We don't find them uncomfortable in the sense that we want to sell them, but they're not prices at which we added to Coke one time about, 5 years ago or thereabouts, and it's conceivable we would add again. It's a lot more conceivable we would add and subtract. But that's the way we feel about most of the businesses. We did make a decision last year that we thought bonds were relatively attractive, and we trimmed certain holdings and eliminated certain small holdings in order to make a bigger commitment in bonds. Charlie?
Yeah, you talk about quality versus price. The investment game always involves considering both quality and price, and the trick is to get more quality than you're paying for in the price. It's just that simple.
But not easy.
No, but not easy.
Area 10.
Gentlemen, good afternoon. Jeff Kirby from Green Village, New Jersey. Would you comment, please, on tax-free spin-offs to shareholders in general, and particularly how you would feel about those were you to believe that a materially higher value would be ascribed to one of your operating companies in the public arena than as part of Berkshire Hathaway?
Well, there's certainly been times in Berkshire's history when certain components of Berkshire might well have sold at higher multiples as individual companies than the amount they contributed to the whole of Berkshire, although I don't think that would be the case now. But our reaction to spin-offs would be, even if we thought there was some immediate market advantage, it would have no interest basically to us. That we like the group of businesses we have as part of a single unit at Berkshire. We hope to add to that group of businesses. We will add to that group of businesses over time. And the idea of creating a lot of little pieces because we could get a little more market value in the short term, it just doesn't mean anything to us. Charlie?
Yeah, it would add a lot of frictional costs and overheads. And we have I don't know of anybody our size who has lower overhead than we do. And we like it that way.
Yeah, right now our after-tax cost of running the operation has gotten down to a half a basis point of capital value. When you think that many mutual funds are at 125 basis points, that means they have 250 times the overhead ratio to capitalization that we have.
And all they got's a bunch of marketable securities, and we got that plus businesses.
Yeah. We don't need any more.
But we can get lower, Warren. We can get a lot lower.
I know. You think they'd work for $500 a year instead of $900, Charlie? Groans from the front row. Area 1.
Good afternoon, Mr. Buffett and Mr. Munger. I was kind of curious if you could tell me, do you know or can you tell us how much business Nebraska Furniture Mart and Board tell me, do you know or can you tell us how much business Nebraska Furniture Mart and Board investing in the auto industry, and if not interested now, what would change your mind about this industry in the future?
Well, the first question, I don't know what the Mart did, but I do know they had a lot of shareholders there. I've gotten a verbal report on that. There would be less change in their normal business. They do, you're talking about a company that at the Mart that does $800,000 a day on average. It is a big operation. So our shareholders have an impact, but not the relative impact that they would have at Borsheim. Borsheim's did over twice as much this year as last year, and they had a big day. And what was the other question, Charlie?
Industry. The auto industry.
Oh, the auto industry. Yeah, Charlie was big in General Motors in the mid-'60s, right, Charlie? And was your biggest commitment?
I had a temper. Luckily, it passed.
Yeah. No, he made money on it.
Yes, I did.
It's the kind of industry it's interesting for us to follow. I mean, many years ago, it was the dominant factor or overwhelming factor in the economy. It's diminished a fair amount, but it's still a very important industry, and it's the kind of industry that anyone can follow. I mean, you have experience with the product and competing products, and everyone in this room understands in a general way the economic nature of the industry, but we've never felt that we understood it better than other people. So we've seen auto companies at very low multiples sometimes, and with prices that in hindsight look very attractive, but we've never really felt that we knew who among the auto companies 5 years from now would have gained the most ground relative to where they are now, or to gain the most ground relative to what the market might expect. It just isn't given to us, that knowledge. Charlie?
I agree.
Area 2.
Hi, my name is Scott Rudd from Eden Prairie, Minnesota. And my question is this. 10 years from now, and I'm referring to Borsheim's as the retail part of it to the consumer, not so much the corporate division. 10 years from now, what would be the 3 things that you would expect division? 10 years from now, what would be the 3 things that you would expect on a day-to-day operating basis to change the market?
Are you talking about Borsheim specifically?
Yes.
Yeah, I think Borsheim's, I don't know about 3 things, but Borsheim's may be one of a couple of our companies where the internet could be have a huge potential for us. I don't know if that'll happen, but there's no question that we operate, and I've got a message on the internet that at very considerably lower gross margins than does a Tiffany or publicly held jewelry operations. We are giving customers considerably more for their money. We've got way lower operating costs than the public companies. And I say on the internet, our operating costs are 15 to 20 percentage points, and even more in some cases, less than publicly owned competitors. So we've got a lot to offer. Now, the big question people always have with jewelers is, how do you know who to trust? I mean, it is an article that most people feel very uncomfortable buying, and I think that the Berkshire Hathaway identification can help people feel comfortable on it. I think that the experience of customers around the country as they see it, and I don't think that I think it is a product. It's a high ticket item, so saving money gets to be really important, just like auto insurance. Saving money gets to be really important. So I think that the internet could be of significant assistance to Borsheim's in terms of spreading and facilitating its nationwide reputation. So Borsheim's could have a lot of growth, and the internet could be a big part of it. Our job is to get the message to people around the country that they can literally, have us send half a dozen items to them that they can look at with no high pressure salesmanship at all or anything of the sort, and look at the prices, decide what they want, in their own what they want in their own homes, and they will do very well with us. Of that now, but we could have 10 or 20 or 50 times that number as the years go by, and I think we should work very hard on that. GEICO has possibilities through the internet, obviously, also. But anything where you're offering a terrific deal to the consumer, but one of the problems has been, how do you talk to that consumer? The internet offers possibilities. Now the thing is that everybody in the world is going to be there, and why should they click on you instead of somebody else? Actually, the Berkshire Hathaway name may help a little bit on that, although Geico's name is extremely well known. Geico is I said in the annual report we were going to spend $100 million in basically in promotion this year. We'll spend more money than that. The brand potential in Geico is very, very big, and we intend to push and push and push on that. Charlie?
Well, all that said, if the Internet helps some of our business, well, certainly the CD-ROM and the personal computer combined to clobber World Book for us.
Yeah, we paid our entry fee.
Yeah, it's not all plus.
No. Area 3.
My name is George Gatti from Zurich, Switzerland, and my question refers to two food businesses, namely McDonald's and Dairy Queen. Are there major differences in the investment characteristics between McDonald's and Dairy Queen? And if yes, would you explain them?
Yeah, there are
McDonald's and Dairy Queen, and if yes, would you explain them?
Yeah, there are major differences. McDonald's, I can't tell you the exact percentage, but if they've got 23,000 outlets, they own many, many thousands of them and operate them. And then of the remainder, they own a very high percentage and lease them to their operators, their franchisees. So they have a very large investment on which they get very good returns in physical facilities all over the world. Dairy Queen has, counting Orange Julius, 6,000 plus operations, of which 30-odd are operated by the company, and even those, some are in joint ventures or partnerships. So the investment in fixed assets is dramatically different between the two. The fixed assets investment by the franchisee or the person as landlord obviously is significant at a Dairy Queen, but it's not significant to the company as the franchisor. So that the capital employed in Dairy Queen is relatively small compared to the capital employed in McDonald's, but McDonald's also makes a lot of money out of owning those locations and receives, whereas Dairy Queen will in most cases receive 4% of the franchisee's sales in terms of a royalty. At a McDonald's, there's that more than that percentage plus rentals and so on. So they're two very different economic models. They both depend on the success of the franchisee in the end. I mean, you have to have a good business for the franchisee to over time have a good business for the parent company. Both companies have that. To over time have a good business for the parent company. Both companies have that. Charlie?
Is not very much when you stop to think about providing a group of franchisees with a nationally recognized brand and quality control and all sorts of desirable business aids.
No, 4% is at the low. If you look at the whole industry, 4% is in the lower part of the range. But
part of what attracted us.
Yeah.
Part of what attracted us was the fact that part of what attracted us.
Yeah.
Part of what attracted us was the fact that
sell his operation for significantly more than he has invested in tangible assets, and we want it that way, obviously, because that means he's got a successful business, and it means that over time we will have a successful business. You want a franchise operator. You want the franchise operator to make money, and you want him to create a capital asset that's worth more than he's put in it. That's the goal. Area 4.
Good afternoon, Mr. Munger and Mr. Buffett. My name is Patrick Byrne. I'm a shareholder, and I'm here from Cincinnati, Ohio. Back again this year to ask a question to see if I can get the two of you to disagree on a subject. I've picked education as an area where we might see some daylight between the two of you. First, though, on the subject of education, I'd like to offer some brief thanks. I'm lucky in that my parents in the late 70s made a wise choice of buying some Berkshire stock and putting it in a college fund for my brothers and me, and that basically paid for our higher education. I suspect there must be thousands of people like us who had our education paid for by wealth that the two of you created, and we owe you. Although we'd probably all have been a lot better to skip college and keep the stock. Well, on the subject of education, Milton Friedman has said, or has written, that if you really care about poverty in the U.S. and the disadvantage of women and minorities and so on, and you could cure one single thing in the U.S., it would be the public education system. Mr. Buffett, of course, you've been very publicly supportive and done many things, and I'm sure Mr. Munger has as well, for public education. But I noticed last year in this annual meeting, Mr. Munger, well, both of you, I noticed last year in this annual meeting, Mr. Munger, well, both of you business schools, but Mr. Munger, he was a tad critical, I would say, of the U.S. public education system. And I wonder if you two agree with what Friedman says and what you think the importance of public education is and what might be done to improve it.
I'm going to let Charlie go in a second, but I just want to say Patrick Byrne is the son of Jack Byrne, who made a fortune for us by resuscitating Geico when it got into trouble in the mid-'70s. In fact, I met Patrick's dad on a Wednesday night about 8 o'clock at night in Washington when Geico was bankrupt, and it was about very close to being declared so. And after talking with about 3 hours that night, the next day I went out and bought 500 and some thousand shares of Geico that Davey referred to at 2 1/8, so which is 40 cents on the stock that we paid $70 for later on. So Patrick's dad, we may have made the Byrne family a little money. He made us a lot of money. Patrick is now running Dutchheimer's in Cincinnati and doing a sensational job. His brother Mark, on June 30th, if we hit the target date, will be establishing a major operation in London and Bermuda that will in which we will be a very large partner. So he's only got one other brother left, and he's out playing golf in California, but if times get tough, we're going to try and recruit him too. Now, Charlie, with all that time to prepare, what do you have to say about education?
Well, I certainly agree with Milton Friedman that it would be hard to name one factor, if we could fix it, that would be more worthy of fixing than particularly the education, where the failures are so horrible in many big cities particularly. So yes, I think it's a terrible problem, and it needs fixing. Of course, there's a huge debate as to what the best way is to fix it. And I am skeptical myself of big city school systems getting fixed under their own momentums. In other words, I'm quite sympathetic to the people who say we may have to go to an alternative like vouchers, that the incentive structure has gotten so bad in some places that you can't fix it with evolution. It takes revolution. Warren, you're more optimistic about
I'm not necessarily more optimistic. I probably feel, though, that democracy without a good public school system available to the entire population is sort of a mockery, because there's so much inequality to start with. I mean, it isn't just inequality of money, but I mean, my kids, whether they inherit any money, or your kids, whether they inherit any money, compared to the kids of somebody where both parents are struggling keep the place going, or maybe just one parent and living in poverty. I mean, it is so unequal to start with that if you accentuate maybe just one parent and living in poverty, I mean, it is so unequal to start with that if you accentuate giving those who are generally higher up, who have chosen the wrong womb, I think that's just, I don't think the society should tolerate that, or a rich society should tolerate it. That doesn't mean it's easy to solve, because I've said a lot of times that unfortunately it seems like a good public school system is like virginity, that it can be preserved but not restored. And it's very hard when you get a system that's lousy to do much about it, because under those circumstances the wealthy people are going to all opt out of the system, and they're going to be less interested in the bond issues, they're going to be less interested in the PTA, they're going to be less interested, all opt out of the system, and they're going to be less interested in the bond issues, they're going to be less interested in the PTA, they're going to be less interested in the other people's children if they have all opted out, and another for the poor, with the poor being getting the poorer system strikes me as doing nothing but accentuating inequality and other problems that result from that in the future. So I don't know the answers on improving the system. I read some of the experiments that take place, but I do believe, to start with, that if you have a good public school system as we do in Omaha, that you do your damnedest to maintain that, so that there is no incentive for the rich grandparent or the rich parent to say, I love the idea of equality, but I love my grandchildren or my child more, so I'm going to yank him from the public school system, and then you get this sort of exodus, which leaves behind only those who can't afford to make that choice. If there were a way, the idea of competition I like, and I think a good parochial system does, for example, create a better public system, and I think we've had that situation in Omaha. But I think the voucher system, if it simply amounts to giving everyone an additional amount, simply means that the rich get X dollars of the public school system subsidized, but the poor still, or whatever that differential is, remains. I mean, you could have a golf voucher system, because I play golf. I don't play very often, but if I play at the Omaha Country Club, and you could have a system, because I play golf. I don't play very often, but if I play at the Omaha Country Club, and you could have a voucher system so that everybody in Omaha would have more access to wouldn't do the job for the guy who's on the public course, because he'd still be beyond his means to move to full-scale equality with me. I don't think there's anything more important, and I agree with Charlie totally. I think the first 8 grades, you can forget it after that. If you have the first 8 grades right, good things are going to flow, and if you have those wrong, you're not going to correct it as you get beyond that point. And I think that wrong, you're not going to correct it as you get beyond that point. And I think that on the $500 million, I think it is very tough to see results, producing results. I think it should be replicated elsewhere. I think that obviously a fellow in Chicago says that the unions have caused considerable problems in getting adjustments made, but he had the political clout behind him to overcome some of those problems. It ought to be a top national priority. We have the money to educate everybody well in this country, and the question is if we got, can we? And that's something I hope good minds like Patrick's work on. Charlie, you have anything for that?
Yeah, I think when something is demonstrably failing at performing the function to which it's assigned by a civilization, just to keep pouring more and more money into a failing modality is not the Munger system. So I'm all for taking the worst places where there's failure and trying a new modality. And it wouldn't bother me at all to have vouchers only for the poor. But I think we have to do something in our most troubled schools to change our techniques. I think it's insane to keep going the way we are.
So you go for means-tested vouchers, basically.
Well,
I don't disagree with that idea.
But all I know is where it is a terrible place to fail, and part of the trouble is ideological. If you have a absolute rule there can't be any tracking by ability, no matter how much better reading can measurably be taught by systems that involve tracking. Well, people that brain blocked shouldn't have the power. You know, we should do what works.
No, we got plenty. I mean, almost it works. The problem is that once it gets beyond a certain point on a downhill slope, essentially you have the citizens that are able to do something about it essentially opt out, and that I don't know.
I am a product of the Omaha Public Schools, and in my day, the people who went to private schools were those who couldn't quite hack it in the public schools. That is still the situation in Germany today. I mean, private schools are people who aren't up to the public schools. I prefer a system like that. But once a big segment of that system measurably fails, then I think you have to do something. You don't just keep repeating what isn't working.
Well, I agree with that. Patrick, have you gotten your answer? Let's go to Area 5.
My name is Kevin Murphy. I'm from Camarillo, California, and my question is, what do you look for when determining if a person is honest or not?
Well, that's a good question, Kevin. I think generally Charlie and I can do pretty well with the situations we see, but we have to have some evidence of behavior in front of us, and I would say even there's some occupations where we're going to expect to find a higher percentage of people who behave well than in others. But if we work with someone over a period of a few months or more, I think we can come up with a pretty high batting average in terms of how they behave. At Solomon, I think I was able to separate out the people who I felt very good about and the people I was a little more nervous about fairly quickly among the ones I worked with actively. But how you spot that precisely, leave your lunch money on their desk sometime. Yeah, maybe you'll find out in a hurry. But we like people. The great example, is somebody like a Tom Murphy, where they're just bending over backwards all the time to make sure that you get the better end of the deal, or that doesn't mean they aren't competitive. I mean, if you play him a golf game for money or something like that, he wants to win the worst way. But there are people that just they don't take credit for things that they didn't do. In fact, they give you credit for some of the things that maybe they did, and you can get a feel for it over time. Charlie, you have any good guidelines on that?
Yes, I think that people leave track records in life, and so somebody at your age should figure that by the time he's 22 or 3, well, he will have left quite a track record, and the world will be able to figure you out. So I think track records are very important, and if you start early trying to have a perfect record and in some simple thing like honesty, you're well on the way to success in this world.
Johnny Agnelli one time told me, he said, when you get older, you have the reputation you deserve. He says you can get away with it for a while early on, but by the time anybody gets to be 60 or so, they very probably have the reputation you deserve. And the truth is, you can have the reputation that you want. If you list all of the things that you admire in other people, you'll find out that almost everything you list, you may not be able to kick a football 60 yards or something of that sort, but almost everything you list in the people that you admire and like, they're qualities that you can have if you just set out to do that. And didn't Ben Franklin do that, Charlie?
No, sure. I always say that to get what you want is to deserve what you want.
I'll have some more peanut brittle. Area 6.
I'm Nancy Sell from Atlanta, Georgia. You were asked earlier this morning a question about the year 2000 computer problem. Do you anticipate any negative financial impact to the economy or to our companies due to the Millennium Problem? And if so, what financial strategies are you considering?
Well, I don't think there'll be major problems for our companies. You know, there are going to be some problems anytime you have something that big. If people didn't see it coming in 1980 or 1985, they're not going to be perfect at solving it by 2000. You can count on that. But I don't think it has any investment consequences for Berkshire Hathaway that we should be considering now. And I do think you'll see most of the problems in the governmental area. You know, maybe they won't find your tax return for 2 or 3 years. Who knows? Charlie? Yeah. Area 7.
In your description of McDonald's, you have the sense that there's a great business buried in McDonald's and there are two good businesses that are mixed in with it. And the problem is with the real estate and the operational business, that as the company is currently capitalized, they can't earn the same kind of returns they can earn in the franchising business. You were or still are a significant shareholder of McDonald's. I guess my question is, the solution is obvious. Why don't you push for a solution that creates the same opportunity you have at International Dairy Queen?
Well, my guess is, I don't know the details on it, but my guess is that with 23,000 locations all over the world, I think it would be extraordinarily difficult to separate the real estate business out from the franchising business at this point. I think they could have gone a different route. I'm not saying it would have been a better route at all. In fact, I think the odds are they followed the right route in owning and controlling so much real estate. But I just think the problems would be horrendous. Certainly you wouldn't want to sell it and lease it back, because you would not end up with more value, in my view, by doing that. And spinning it off in a real estate trust or something with operating in 100 plus countries, and with all of the franchise arrangements, I think it would be a huge problem. I would not want to tackle it myself. So I think that you should look at McDonald's, and I don't know anything about their plans on this, but I think you should look at McDonald's as being a very good business, but the one that will continue in its present mode vis-a-vis the real estate, although I think they've signaled that they're going to do less on new properties, somewhat less in connection with ownership than they've done to this point. But there's 23,000 locations out there, and every operator, his own arrangement is very important to him, and it would be a mammoth job, and I'm not sure how much extra value would be created in the end anyway. Charlie?
Yeah, the net returns on capital McDonald's has earned all these years are high, even though they have owned a lot of the real estate. I think it's hard to quarrel with the way they did it. They had the best record.
And the multiple is not greatly different, in my view, than if the real estate were separate. You know, I mean, now if you get all the real estate de-taxed in some arrangement, you might get a little more out of it, but it doesn't strike me as a big deal. But, Area 8.
Yeah, hi, I'm Rachel White from Missoula, Montana, and during the lunch break I heard some people talking about double taxation and how that impacts Berkshire's investment philosophy. So I was wondering if you could talk a little bit about it. I'm not sure I understood it, and if you could explain whether that impacts your investments.
Well, we are structured very poorly, and if you were looking, if you're going to start all over again and do most of the things we've done, you'd probably not do it in corporate form or precisely like we do it. I mean, what that gentleman was talking about in connection with McDonald's applies much more to Berkshire Hathaway, even by far than McDonald's, in terms of de-taxing part of the income stream. If we own Coca-Cola with a cost of $1.2 billion or $1.3 billion and a market value of $15 billion, we're not going to sell it. But if we did sell it, we would incur a capital gains tax on the order almost of $5 billion. That means that the 15 becomes 10 billion. Now, if that 10 billion is reflected in Berkshire's value and you bought it, your stock when we bought our Coke, then you pay a second tax in turn in reflection of the Coca-Cola appreciation that's taken place after tax. So it's a very disadvantageous way of owning securities to have a corporation in between you and the securities themselves. If we ran as a partnership, that would not be the case. I ran Berkshire Hathaway, I ran Buffett Partnership for many years, and we only had one tax at the individual level. So our stockholders are, to the extent that we own marketable securities, and we own a lot of them, and to the extent that we have a lot of profits over time in those, own those securities in a disadvantageous way. Now, we also have a float, which helps us own them, which is a big plus. But corporate ownership of securities, if you have the option of owning them directly or through a partnership, corporate ownership is disadvantageous, and we're stuck with it. We've had it for all these years. We've got no plans to do anything about it. We couldn't probably do anything about it if we wanted to. So that is a drag on our performance compared to what would be the situation if we operated as a partnership. And Lloyd's syndicates, for example, didn't have that problem. Some insurance companies that operate in Bermuda may not have that problem to the same extent. Certainly partnerships don't have that problem to the extent they own securities. But it's a fact of life with us, and we're going to pay a lot of taxes. Charlie?
No, we have no cure for the corporate income tax, and it is a big disadvantage for the indirect owner of securities. So far, we've surmounted it well enough, but we're carrying a load there.
It's become a bigger disadvantage since the individual rate went to 20%, with our corporate rate being 35%. Because if we make $1 on a stock, it becomes 65 cents, and to the extent that you've owned Berkshire, that 65 cents now 20% off that becomes 52 cents, whereas if you'd owned the stock directly, you'd have had 80 cents. Now, when we owned Geico and it wasn't consolidated with us, you carried that one more extreme. I mean, Geico had capital gains, and we had a capital gain proportionally in Geico, and so on. I mean, how you're structured does make a real difference, but usually once you get into a given structure, you're kind of stuck with it, as I indicated in the answer to the gentleman on McDonald's.
Now, to the extent we have very long holding periods at the corporate level, the real mathematical disadvantage shrinks.
Yeah, and we might not have been able to get the float that we have if we hadn't been operating it in a corporate structure, so that is a mitigating factor too. But we like to have the mitigating factors without anything to mitigate if we get our choice. Area 9, please.
Good afternoon. My name is Fred Strassheim, and I'm from here in Omaha. I have a question about your acquisition methodology, and I was intrigued to read in your annual report about your acquisition of Star Furniture. And as I understand the process you followed, Mr. Buffett, you met with you reviewed financials for a brief period, liked what you saw, then you met with Mr. Melvin Wolf for 2 hours and struck a deal, and you wrote you had no need to check leases, work out employment contracts, etc.
Right.
I think that most companies, when they do acquisitions, would feel the need to do a significant amount of legal due diligence, to do things like check the leases, check into things like undisclosed environmental liability, or perhaps threaten litigation. And I guess my question is, have you ever been burned by your approach?
We've never been burned by we've been burned only in the sense that we've made mistakes on judging the future economics of the business, which would have had nothing to do with due diligence. We regard what people normally refer to due diligence as really sort of boilerplate in most cases. It's a process that big companies go through, and they feel they have to go through it, and they're ignoring, oftentimes in our view, they're ignoring what really counts, which is evaluating the people they're getting in with it and evaluating the economics of the business. That's 99% of the deal. You may run into an environmental liability problem, one time in 100, or you may find a bad lease. I asked Melvin about, do you have any bad leases? I mean, that's the easiest way to do it. And I can read them all and try and look for every clause or something, but it isn't going to, that is not the problem. We've made lots of bad deals. We made a bad deal when we bought Hochschild Kohn, for example, a department store operation back in 1966. But it had fine people, but we were wrong on the economics of the business. But the leases didn't make any difference, or that sort of thing just was not important. And I can't recall any time that what other people referred to as due diligence would have avoided a bad deal for us.
I can't either.
No, that's 30-some years. And the key thing, you just don't want to do. I'm on various public company boards. I've been on 19 public company boards, and their idea of the due diligence is to send the lawyers out and have a bunch of investment bankers come in and make presentations and all that. And I regard that as terribly diversionary, because the board sits there, entranced by all of that, and everybody reporting how wonderful this thing is and how they've checked out patents and all that sort of thing. And nobody is focusing really on where the business is going to be in 5 or 10 years. And business judgment about economics and people to some extent, but the business economics, that is 99% of deal making, and the rest, people may do it for their protection. I think too often they do it as a crutch, just to go through with the deal that they want to go through with anyway. And of course, all the professionals know that. So believe me, they come back with the diligence, whether due or not. And we are not big fans of that. I don't know how many deals we've made over the years, but I cannot think of anything that traditional due diligence has had a thing to do with. And
no, we've had surprises on the favorable side a couple of times.
That is true. That is true. The kind of people that we've generally dealt with have usually told us the bad things first and good things after we made the deal. We made a deal with a fellow over in Rockford in 1969, Eugene Abegg, the Illinois National Bank and Trust Company. I made that deal in a couple of hours, and I mean, there just wasn't any way that Gene was going to be hiding anything bad. For the next 10 years, when I went over there, every time I go to lunch, he'd point out some building in town that we owned that wasn't on the books, or some foundation we had that had money in it that he hadn't told me about. And he even gave me some bills, one of which I carry in my pocket, that he had still sitting around that were issued by the bank, that were our own money, which he never told me about. We could cut them out like paper dolls. I mean, Gene was not a guy to show all his cards. And those are the kind of people we've generally dealt with. And I would certainly say that that Melvin and Shirley fit that description in spades. We're now at 3:30. It's been a lot of fun this weekend. I'm glad you came, and I hope to see you next year. Thank you.